Good morning. It is Wednesday, July 19th here in New York City. This is Yahoo Finance Live. I'm Julie Hyman. That's Diane King Hall. Brad Smith is off today. Here are three things you need to know this morning. Goldman Sachs, the last big bank out of the gate, and the results not great. Profit falling 58% from a year ago, missing analyst estimates. Earnings taking a big hit from the bank's ongoing exit from consumer lending. Goldman wrote down $504 million of goodwill related to its consumer platforms unit. That unit, including specialty lender GreenSky, which Goldman just bought last year, but it's in the process of reviewing bids from potential buyers for it. The results are likely to intensify the scrutiny of CEO David Solomon, who is wrestling from everything from partner unrest to concerns about strategy. Troubled used car retailer Carvana reached a deal with bondholders in an effort to lower interest payments and put its business back on more solid footing. The agreement reduces the company's total outstanding debt by over $1.2 billion. It also eliminates more than 83% of Carvana's 2025 and 2027 unsecured note maturities. The company thrived during the pandemic when demand for cars surged, but a lot of debt, a big acquisition, and falling used car prices sent the stock and the company down a bumpy path. The company's chief financial officer, Mark Jenkins, says this transaction will help, quote, drive significant profitability and help Carvana return to growth. Shares are soaring on the news. And Netflix and Tesla are the first of the tech giants fueling this year's market rally to report second quarter results. That comes after the close today. Tesla shares are up nearly 130% this year as investors have celebrated everything from the company's AI-related hype to the rapid expansion of its supercharger network. The primary focus for Tesla will be on gross margins as investors weigh how recent price cuts are affecting profits. As for Netflix, shares there just above 50% this year. Investors hoping to see benefits from the password sharing crackdown and keeping a close eye for commentary from company executives on how any fallout from work stoppages in Hollywood could affect the company.
Now, Goldman Sachs is the last of the big banks out the gate. Results indeed not great. Profit at the bank fell 58% from a year ago, coming in at $3.08 per share as investment banking and trading fell. The results are likely to intensify the scrutiny of CEO David Solomon, who is wrestling with everything from partner unrest to concerns about strategy. Joining us now for a deeper dive is Devin Ryan of JMP Securities analyst and Bill Cohen, Puck News founding partners. So Devin and Bill, thank you so much for joining us. Devin, I want to start with you with this analysis. We knew there was weakness coming into this. Was there anything that stood out to you about where in particular that Goldman went wrong?
Nothing really stood out. I mean, listen, we knew this was going to be a tough quarter and it was going to be messy. And I think that's exactly what it was. About 5% return on equity drag came from all these kind of unusual items, the marks on GreenSky and Marcus and some other marks in their equity book in asset management. And so those are items that, hopefully we don't see every quarter. And then, really the story here is going to be, one, do the capital markets recover? And we can talk about that, but we are starting to see some green shoots. So I think that's where the conversation is going to go as the day goes on here. But, it was a messy quarter directionally as expected, but, they have to, I think, own some of that. And so here we are.
Here we are indeed. Hey, Bill, it's good to see you. Devin doesn't sound that negative here. I know there was a lot of pressure and discussion over David Solomon's leadership going into this. As somebody who has tracked this company for a long time, do you think he is in jeopardy?
Well, Julie, it's nice to see you too. Look, when it comes to Goldman Sachs, where there's smoke, there's fire. There's been a lot of dissatisfaction during the course of this year with David's leadership. I think it's kind of crunch time. I think this was sort of a kitchen sink kind of quarter where they took their write down on GreenSky. They took their write down on their commercial real estate holdings. They've obviously dinged their net income significantly. Their revenues were down, but their expenses were not down nearly as much. So if David hasn't righted this ship in the third and fourth quarters, everything that I'm hearing is his tenure could be in jeopardy. But at the moment, I think he's okay. But he's got to get this thing back into a much more Goldman-like framework in the next two quarters.
Devin, I got to ask you, you did give the caveat about capital markets recovering and when do they recover. But with Goldman in particular, has it lost its edge given these results, or do we think this is kind of a one-off?
So you actually peel back the onion, and their market share is as good as it's ever been. They're actually still gaining share virtually across every business, and they're building in more stable businesses as well. Asset and wealth management, they're still seeing nice growth there. Their financing revenues are growing, which are stickier. This is really a function of the capital markets have been shut for the last 18 months, and Goldman is the most levered to that theme. People quickly forget how good 2021 was, and Goldman significantly outperformed, and everything looked great. We've been the opposite side of that trade for the last 18 months. To give you just a couple stats, equity issuance, if you just look at a long-term trend line, equity underwriting revenues would have to increase by about 60 to 70% just to get back to a long-term historical trend line, looking at 30 years of data. For M&A advisory, the long-term trend line of announcements relative to the first half of this year would have to increase by over 50%. So those are two big businesses for Goldman. It just gives you a little bit of an order of magnitude of how tough they've been. But if those recover, I think that takes care of a lot of this, I'll call it noise on the outside. It's just been a really tough backdrop, and Goldman is entirely levered to, essentially investment banking and capital markets.
It is entirely levered to that, but Devin, it tried to be levered to the consumer as well, and that seems to have been kind of a spectacular failure, no?
Yeah, I think it's definitely been a failure. It's a long conversation, I think, around what happened there. I think the market mood changed. Consumer is a business that, they probably would have had to build out for 10 years to get to the scale that would be relevant to Goldman. And that's the journey they were embarking on when interest rates went from 0 to 5%, and there was no appetite in the market for companies, whether it's within Goldman Sachs or a standalone tech company or consumer-facing company, to lose money. When that appetite changes, you have to make decisions. And so, that was a big driver of kind of paring it back. And this was going to be a really long build, and the market, I think, and investors lost appetite for that. And clearly, I think some internal friction as well, because capital markets were performing so well, and this was kind of dragging down overall results. It's a small fraction of what Goldman Sachs is and would have been for a number of years. So we're not losing sleep over it. You just need the capital markets to recover here, and that'll take care of a lot of the issues.
Bill, I want to ask you, what would it take to restore confidence in Solomon as a leader?
Well, I think, Devin is absolutely right. I mean, the capital markets have to improve. Goldman is highly levered toward investment banking. That market has been in the doldrums for the last year or so. He's trying to clean up the consumer banking foray. I mean, look, I can't blame him for trying that. Goldman is sort of in a box with the Federal Reserve. They can't really do what they need to do strategically because the Federal Reserve won't allow that kind of merger. They really need, a much bigger deposit base. They need a bigger commercial balance sheet. They need a lot of things they can't get just through organic growth. So David was trying something. He's gotten a lot of flack for his DJing and his use of private jets and sort of extracurricular activities. That's probably unfair. The stock is held up okay, but here's the thing. I think what we're seeing right now is a huge bifurcation in this market where you see, people with the big balance sheets, JP Morgan Chase, and the deposit base, Bank of America, throwing up pretty amazing earnings under the circumstances. JP Morgan's net income was $14 billion. I mean, Goldman's was just a fraction of that. I mean, what you're seeing is this bifurcation where these companies that have a huge deposit base where they're paying nothing for those deposits can lend that money out at huge spreads with the rising interest rates, and that's just gushing to the bottom line. Goldman doesn't really have anything like that, and even in markets, they're paying up for those deposits much more than JP Morgan Chase or B of A is. So, they're in a bit of a box, but David's got a couple more quarters to figure this out. And if he doesn't, I think the old guard is going to make a move.
And Bill, sort of on a related note, I remember when Goldman was the killer, right? it was just sort of
Absolutely.
the bank to be feared. And I guess that's a legacy of my coverage of them in particular during and after the financial crisis. Did they ever reattain that?
I mean, Devin is right. I mean, 2021 was an amazing year. I mean, more profits than, you need to sort of look over a 2 to 3 year period and then aggregate the profits. I mean, they sort of brought forward a bunch of profits that they've been missing out on lately. But in 2021, I think that, Goldman used to be able, Julie, you're absolutely right. I mean, obviously I wrote a book about it. They figured things out. They've always been the best at figuring things out, no matter the market conditions. And I'm wondering if they're figuring this out at the moment. It seems to have lost its swagger, its luster. It's still everybody wants to work there. Harder to get a job at Goldman Sachs than it is to get into Harvard. But I mean, still, they're not as feared like they used to be. People are fearing J.P. Morgan Chase at the moment. They're fearing what James Gorman has done at Morgan Stanley. But at Goldman, I don't know. And it's not the Goldman it used to be. Can it regain itself? Can it regain its 2021 swagger? My bet is it can, but time is running out on David.
Really interesting perspective, both of you. Thank you so much. It's very helpful. Devin Ryan, JMP Securities Analyst, and Bill Cohen, Puck News founding partner. Thank you.
Thank you.
Well, Goldman Sachs' weak results were largely an outlier among the big banks. Earnings in the financial sector have mostly been better than feared, adding fuel to growing sentiment that a recession may come later than economists had expected. Leaders of the biggest financial institutions in America are calling out a resilient consumer and economy in their earnings reports and commentary. Yahoo Finance's executive editor Brian Sozzi spoke with Bank of America chairman and CEO Brian Moynihan, who is dialing back his expectations for a mild recession this year.
People are working and they're getting paid more and they're spending. It's going to be hard to have a tough, U.S. economy because of the amount that's driven by that. But I'm not surprised by the resilience of the consumer, because when we looked at our customer data, you can go back and track us talking quarter after quarter. Our customers still have multiples in their accounts. Those same customers that were here in early 2020 today have multiples in their accounts than they did back then, especially in the lower balance accounts. And that's because they've spent some of the stimulus, but they've been earning money and they've been managing their finances well. That doesn't mean certain ones are having difficulties and layoffs are happening. But in a broad context, across 60 million customers, across $4 trillion of spending, it's a pretty resilient group.
Well, that sounds like a rosy picture. While earnings season has just begun, it does seem like the bellwether this quarter is shaping up to be the financials, despite the sector's earlier chaos this year. For more, we're joined by Daryl Kronk, Wells Fargo CIO of Wealth and Investment Management. And indeed, it has been really interesting how well the financials, let's leave Goldman aside for a moment, but how well they've done. And can we sort of extrapolate that out to the rest of earnings season at all?
I'd be careful probably about extrapolating it out. I think financials have exceeded. What I've had my eyes very closely on is both what Brian just referenced, which is the consumer and the trends. So the consumer has been resilient. The consumer always remains resilient into a slowing economy. In fact, the consumer is often the last one to kind of give up the ghost, if you will. They will spend right up to the edge of potentially a recession and jump right over the cliff into it. We're starting to see some of that in the numbers. So if you go back to the pandemic, huge amounts of transfer payments to consumers who built big savings balances. They've ground through those savings balances. Late last year, early this year, we saw big increases in credit card spending. And now just in the last month or two, credit card spending literally dried up. Like it went just dead silent, which is often a very late cycle indicator, because it means the consumer's kind of hitting the wall, right? If they don't have the savings anymore to spend and they can't use the plastic, right, then they stop spending at some point. So I think it's a really important trend to watch. We're seeing in just this quarter's earnings, we're seeing credit card delinquencies rise from a very low level, but rise nonetheless. We're seeing auto delinquencies rise from a low level, but rise nonetheless. So there are some trends there that bear watching, I think, directionally, even though they're not at the normal magnitude you would expect in a late cycle event.
So I feel like that's kind of the glass empty or glass half empty side of the equation. Could it be though the glass half full side of the equation when you think about just the strength of the labor market backing up that spending that we're seeing? Sure, there's a little bit of tapering we are seeing, but again, it's not the magnitude that you would expect. in terms of like what we're seeing in the financials and how these banks are holding up. We're also not seeing massive outflows. What do you make of that?
Yeah, I think that's right, Diane. And I think we've got this air pocket of labor. Both firms have been resilient in not wanting to let go of their high-valued employees. But coming out of the pandemic, we had 10 million job openings and 6 million unemployed workers, right? We've never seen an environment like that where there was that big of a mismatch. So it's not surprising that labor has remained sticky. Now, I think what you have to parse there is it labor just being sticky and not rolling over, or is it that companies are robustly out there hiring today? We don't see the robust hiring side, call it the demand side of the equation. In fact, what you really need for that to kick in is you need earnings growth. And you need top line revenue growth, right? So we're going to be the second quarter in a row of negative earnings or revenue growth, third quarter of negative earnings growth, and the sixth quarter in a row where we've seen margins decline. So if that environment happens and demand comes down and your single biggest cost on your income statement is labor, you would expect that if it's typical to a normal cycle, in the coming months, those layoffs would start to pick up a little bit. But you're right, the resiliency has been really strong.
But is it typical to a normal cycle? I mean, the thing that kind of comes around to me as we go through each earnings season, you know, we kept talking about normalization coming out of the pandemic. And then the conversation goes away, but really we're still there. I mean, when you talk about the credit card delinquencies, for example, they're ticking up, but they're still below where they were in 2019, which is remarkable to me. And it feels like there are all still these tension points in the economy that are not normal, whatever normal even means anymore.
That's true.
Right? So
You're right, Julie.
we're still, what is that process still like, and how difficult does it make your job and our job to try and figure out what's going to happen?
Very difficult, right? Because if you looked at a lot of the historical indicators and the fundamental indicators, you would basically say the economy is very late cycle and probably heading to recession, which is why you had 70% of economists claiming coming into this year that the economy was going to go into a recession. That intense bed of liquidity that we just got done talking about probably extended the duration of how a number of those normally roll over and act. But at the end of the day, the consumer is the engine of the economy, right? And labor is what will matter there. What's interesting is, so we all know the Fed started hiking interest rates in March of 2022, right? Very first hike at 25 basis points. The unemployment rate in March of 2022 was 3.6%. The unemployment rate today is 3.6%, right? It hasn't moved, notwithstanding the Fed has increased interest rates 500 basis points, right? So does that mean labor is different this time, or this time is different? Maybe. Where you see strength in the economy, I think the important point here is you have to parse, is it supply push or demand pull? Because they're two different things. So think about, we've seen strength in labor, we've seen strength in housing, we've seen strength in travel and all those types of things. So take housing, for example. People aren't lining up to buy 2 and 3 new homes, right? That's not happening today, right? Why is housing strong? It's strong because there's such a supply dearth, right? There's only been 1% of homes turn over this year, right? Same thing with labor. There's a dearth of labor, right? It's not that companies are running out there to hire a whole bunch of new people. Same thing in travel, right? Airlines have done what? Cut the number of flights. So if you want to go to Europe, right, this summer, you're going to pay up because there aren't the seats there.
In that case, it feels like there's quite a lot of demand for travel, though, too.
There is. There's pent-up demand from the pandemic, right? Of people just wanting to get back out there and do their thing again. But it's kind of colliding with this reduction in supply of what's available for seats. If you go try to find a summer seat on an airline this summer, best of luck to you, right?
Oh, whoa, wow. Okay, I have one more flight to get to.
Yes, okay. All right, sorry, Diane.
I better book that.
You better get that booked.
Exactly.
Right.
All right. Daryl Cronk stays with us. We want to pivot, and investors cheered last month's cooling U.S. inflation data as an encouraging sign for the economy's recovery and a hint that we may be nearing the end of the Federal Reserve's rate increase cycle. But our guest says inflation could actually get worse before the year is done, and markets may be in for a shock. We want to welcome back in Wells Fargo, Daryl Cronk with us now. So let's do a deeper dive of this. You kind of teased this out. We have some notes that you shared with us. We know inflation cooled, but your take on this is not so fast, basically, in terms of how we interpret this.
Yeah, if you look at past inflation cycles, right, and I think it's true of this one too, is you typically have a quick rise in inflation, We saw that last year, peaked at 9% on the CPI in June of last year. A quick fall in inflation, and then often it bumps along in a kind of a consolidation phase, and then it rises again. That's about how all of them have happened. What's interesting is, okay, you start breaking down what are the components that drive inflation, right? So we saw inflation drop nicely last week, and CPI came down from 4% of the headline to 3%, right? If you look at the back half of the year, you say, okay, is that trend going to continue? Which I think markets have bought into, right? This immaculate disinflation, and we're just going to go down to the Fed's 2% number and stay. But think about it this way. Just in the year-over-year comparisons, which is how we measure inflation, the rate of change, you need oil prices to be at $70 to keep inflation flat. Oil today is at 80, right? So it needs to come down. Gasoline futures and prices are up 20% in the last 60 days, right? So you think about inflation at the headline number, energy and food, right? And then I get into the core number, which is still sitting at 4.8, way above where the Fed wants to be, right? What are the drivers of core? Shelter, housing, right? We just talked about housing and the strength there. So you need the housing market to kind of roll over. You need wages to roll over and labor to roll over, which so far has been sticky and hasn't happened yet. So I think the risk here, and again, it's a risk, is that in the back half of the year, inflation could actually tick higher. It's not going back to 9%, but it could go from 3% back closer to 4%, which then has the Fed in a very different position. The Fed is not done in July then and needs to do more work later this year, candidly.
Even if it doesn't tick back up, even if it stays around where it is right now, we've talked to a number of investors who have suggested the market is wildly over-optimistic in thinking the Fed is going to be cutting next year because of a drop in inflation. It sounds like you're in that camp as well.
Yeah, I think it's tough to make the case for big, massive cuts. You reverse engineer that argument and say, why would the Fed aggressively cut when they've been so diligent and so resilient on the inflation conversation?
If the recession arrives and
Correct.
Inflation goes way down.
Yeah, I mean, basically the Fed would have to do quick and emergency cuts if the economy does the Thelma and Louise right off the cliff, right? None of us want that, and we're not predicting that, but I'm just saying that's the recipe for why the Fed comes back aggressively and says, wow, we've got to reverse course and add stimulus back into the economy. Right now, they're talking about still tightening policy, not easing policy. And the market has perennially got this wrong. The market has been pricing in cuts, and keep pushing that out on the calendar. Now it's pushed out, if you look at Fed funds futures, out into kind of mid-2024.
So obviously the vast majority expect next week that we're going to see a hike, but many industry experts that we talk to think it's kind of going to be one more and done. You're not in that camp, I'm guessing.
I don't think so.
Is it a to and through?
Yeah, I think it's more that, to be honest, Diane, because again, the data just doesn't suggest that that's going to be the case. And what's interesting, and this will be an interesting case in behavioral finance or psychology that will get studied at business schools for years, right? Which is the Fed has never wavered on their message, right? For the past 12 to 18 months. Powell has been resilient in saying, look, we are going to see this through until we get to 2 to 2.5%. Even if you assume inflation doesn't tick back higher, like we just talked about, 3 to 2, that last mile traveled is a really hard mile. You've got to tighten policy aggressively even from here to get us to 2, in our opinion, unless you drop into a recession, which would be disinflationary or deflationary. So we think the Fed probably does have more work to do. That's not priced into the market today, right? The market has to reset that. And that's going to probably create some volatility in the back half of the year. So here at mid-year, we'd kind of fade this big move in equities, this 16, 17%. You know, it's been all on multiple expansion, nothing on earnings growth, which has been well documented. So, you know, what multiple do you want to pay for the next dollar of earnings? Do you want to pay 21, 22, 23 times in a slowing growth environment and an environment where policy is still tightening? I would be careful there.
So it sounds so. You're saying you think that stocks are going to come to that realization. What's going to cause them to come to that realization, right? So what would change? The momentum is clearly the upside.
It is. The pain trade is to the upside.
Yeah. What's going to change that?
So what will change that will be inflation and Fed expectations. But more importantly, everybody talks about what the Fed's going to do with Fed funds. And, you know, there's been some out there saying the Fed will need to take this to 6% or possibly even higher to ultimately arrest inflation. What's interesting, if you go back and watch market action over the last 12, 18, 24 months, every time the 10-year Treasury, the long side of the curve, has gotten above 4%, it's gotten really hard on equities. We just experienced that earlier this year. We experienced it in October of last year. When you drop below 4, it's kind of party on, right? And everybody just believes that, that low interest rate environment on the long side of the curve, which is pegged to growth and inflation, tells you that, the Fed has done its job and they've won the war. And we're just not so convinced. And history would be on our side of that, which is it's not just easy to arrest inflation once it goes higher, right? Like I said, it goes up quickly, comes down quickly, and then often has resurgence periods of time. So if it were that easy, we'd have heroes for past Fed chair people, right, who have done this miraculously, when the only one we probably lift up is Paul Volcker, who took interest rates all the way to 20%, right, to finally arrest inflation.
Yeah, I think people forget how painful
Yes.
it was to stop inflation then. Daryl, thank you so much. Really
My
interesting
pleasure.
perspective.
Yes,
Daryl Cronk is Wells Fargo CIO of Wealth and Investment Management. Thank you. Let us turn to Carvana. Shares are shifting into high gear this morning after the company announced a deal that would reduce its debt by more than $1.2 billion. Yahoo Finance's Pras Subramanian joins us with the details. And this is a bit of a complicated deal here with multiple parts. So talk us through it.
Yeah, Julie, very complicated lifeline for the company, I would say. Striking an agreement with their bondholders, eliminating around 83% of its debt due in 2025 and 2027, meaning its debt load will actually decrease by $1.2 billion, and its interest expense will go down by $430 million over the next year. So a lot going on there. Kind of huge for a company that was bleeding cash not too long ago. For the bondholders, the new notes are secured higher up the debt food chain, secured by assets of Carvana and Adesa, its online auction business. Separately, the company has filed a secondary offering to sell 35 million shares at around raised around $350 million. So, another move there. Also, kind of that had a little bit of a downward pressure on the stock, but not much. And finally, Carvana announcing Q2 financial results. Vehicle unit sales missed estimates, but revenue and profits topped Wall Street expectations.
Well, and I want to pick up on that, Pras, because, there's Carvana, the fundamental business, and then there's Carvana, the debt story, right? So today's more about the debt story, but dig into those actual results a little bit more. We know that used car pricing has been moderating, right? What does the demand side look like? What does the prospect look like for a Carvana?
I think one of the key kind of metrics that caught my attention was, so they didn't miss on the vehicle sales total, but they actually increased their profit per sale by almost double to over $6,000 per car on average. So that's really strong for them. I guess the key is can they bring down some of those operational costs? It seems like they're selling cars once again at a profit. So it seems like the demand is there. Pricing is pretty competitive with other offerings. So I think that they're in a good driver's position here, a driver's seat here. The question is, can they bring down a lot of those structural debt costs? And it sounds like they are doing that. And I think for the bondholders, they're happy to take on this deal to get a better situation from like a credit point of view, from a the asset point of view. So I think it's a good win for both sides. But I think you're right, Julie. It's a question: can they right the ship and become profitable at some point?
Yeah, we'll see. And we'll see if they keep getting rewarded even when they're not. Pras, thank you so much. Appreciate it. We got the opening bell coming up in a sec. You're watching Yahoo Finance. Will the S&P 500 be higher or lower at the end of earnings season?
Oof, I wish I knew the answer to that definitively. I guess I would say right now the momentum is obviously moving in the higher direction. Earnings expectations, negative 7% growth year over year, so the bar is still pretty low, easy to get over it. I guess if I have to choose one, I'd say higher.
All right, we just had the opening bell on Wall Street. We want to do a quick check of the market's early action. This quick check sponsored by Tasty Trade. We're looking at all three of the major indices. In the green this morning, Dow better by nearly 0.5%. The S&P's up just shy of 0.4%. Nasdaq matching that on a percent basis. Let's get over to Julie Hyman at the Wi-Fi Interactive.
You know, we've been talking about the momentum trade, right? The momentum that's behind stocks ever since earnings season began. So let's take a look at the 5-day charts here. And we have seen this surge in stocks, 2.25% for the Dow Jones Industrial Average, which again just reflects really what we've seen from the financials, by and large beating estimates. The S&P over that period of time up about the same, and the Nasdaq, let's take a look, they're up about 3.5%. So it's not been just the banks, although there are some financials in the Nasdaq. It has been this broader rally that we have been seeing. So what does that rally look like in today's session? If you take a look at the sectors here, all of them are in the green here, being led, actually, are we looking still at the, yeah, we're looking at intraday. Yeah. Real estate up 1.25%. Interesting what we're seeing there. Healthcare up by nearly 1%, utilities higher, industrials and materials lagging a little bit here, and the financials up just about 0.25% as we look what's going on. I mentioned the Nasdaq leadership over the past 5 days and, of course, over the year to date as well. So if we look at the Nasdaq 100 and the movers here, we have seen the surge in some stocks, in particular Tesla, which reports after the close up 0.2% today, up 8.5% going into that earnings report. Netflix over here, let's take a look at that, up 7% going into its earnings report. So that's something important to note. And I want to take note of Microsoft as well. Now, Microsoft getting a new deadline date to close on its acquisition of Activision to October 18th, so pushed back several months here. And at the same time, the stock trading at a record, just barely today, but trading at a record, yesterday unveiled the pricing for its new AI-powered Bing, and that helped push those shares higher. So that was an interesting thing to watch. Lastly, just a quick check on the banks once again today, as of course we are watching those reaction to Goldman earnings. There's the 5 days, so let's take it to today. We are seeing just about 0.25% pullback for Goldman Sachs as it reports its numbers, and they are not quite as strong as some of the other banks that we have heard from.
Yeah, speaking of banks, let's get into some other banking stocks moving this morning. U.S. Bancorp released its Q2 results today, beating street expectations, but the stock falling after posting a narrow net interest margin due to higher deposit costs over debt ceiling concerns. First Horizon National missed the street expectations on revenue and adjusted EPS, but the bank released posted a profit for the second quarter that increased from the year prior. First Horizon said it grew the period ended deposits by $4 billion on a quarterly basis. You're seeing the stock pop right now. Citizens Financial Group reported a profit that beat the street expectations. Now, the bank lender saw a boost in net interest income. That's a key line item analysts have been watching for thanks to high interest rates. But the company expects net interest income to fall in Q3. And M&T Bank beat Wall Street estimates. The bank's total deposits rose to $162.1 billion from $159.1 billion at the end of the first quarter. So you're seeing a pop there because we know the deposit outflows. I know it's a lot. We got a lot of banks in there just now. So we know that one of the line items that analysts have been watching for is deposit outflows. We've seen a little bit in some of these earnings reports, but not worrisome when you think about some of them.
Yeah, and our Allie Canal is with us again today to talk us through some of these movers. So, Allie, it has been interesting here it feels like there were two really areas of concern for the regionals. Are they going to hold on to the deposits, and how much is it going to cost them to do so? And by and large, at least the share price reactions have been positive.
Yeah, and I think a lot of focus was on the banks this quarter, given what we saw in the spring with the collapse of SVB, a particular focus on the regionals. And by and large, we see results that have come in mixed, right? You mentioned those higher interest rates helping to boost some of that profit there. I think the key to the banks that have done well are the ones that have diversified businesses, because we're seeing those that heavily rely on deal making, heavily rely on investment banking. Case in point, Goldman Sachs, they have struggled a bit. I'm curious, so looking ahead to the quarters to come, Q3, Q4, how will the pullback in consumer spending, possible credit tightening, a potential recession in the back half of this year, how will that impact the banks? I think there was so much emphasis on this quarter that, better than feared.
Yes.
So far, so good. But I wonder what this means for the back half of the year.
Yeah.
Well, we'll certainly be watching that. I mean, go ahead.
I was just going to say to that point, we have seen some of the banks say that net interest income is going to not be as strong, or the momentum will not be on their side in the second half of the year. It seems like, at least today for these regionals, that investors are saying, okay, it was worth it to spend to keep those deposits in many of these cases. If you look at Citizens as just one example, the Wall Street Journal pointing out that deposit costs in the second quarter were up 40 basis points, which is an increase. However, it helped them hang on to deposits and, in fact, increase their deposits. So it seems like that's sort of the calculation here that investors appear to be making.
Yeah, indeed. All right, let's switch gears and look at another stock. Earnings in focus for Halliburton. Shares in focus this morning after releasing its latest quarterly report card. Now, it was a mixed bag for Halliburton. Earnings beat at $610 million, 68 cents a share, 77 cents a share on an adjusted basis. Revenue came up short at just under $5.8 billion. So you're seeing the stock get dinged as a result of that miss. Their stock down a little over 8% in terms of Halliburton. So they have some challenges in front of them. But I mean, one thing that could be helpful in the long run is the price of oil.
Yeah, price of oil, which is actually crude right now, up on the month, up about 6%. So demand seems to be improving on that side. One thing that stood out to me from this release was that North America revenue fell sequentially, 2% quarter over quarter to $2.7 billion, while international revenue actually increased 7%, led by improvements in Latin America, Argentina, and Mexico. So more drilling overseas than in the U.S.
Which makes sense given the forecast from OPEC, which they predicted that demand would still be there.
And Halliburton, like as an oil services company, like the oil majors, is continuing to try to support its stock by returning cash to shareholders. In its case, it bought back $248 million of stock during the quarter. It also highlighted its free cash flow in the quarter of $798 million. So this is, you could argue that this creates a floor under many of both the oil exploration and production and oil services stocks that they continue to pay out to their shareholders. Finally, a stock that's trending this morning, Elevance Health. Shares there are rising after the American healthcare company raised its full year guidance above what Wall Street had estimated. Quarterly earnings also beating on lower than expected medical costs at its health insurance unit, and the stock is up by some 7% today. We have been watching the medical cost ratio, which ticked up at United Health, a bigger competitor, but it looks like improving.
And look, Elevance also increased the cost of, or the rate of premium. So it's, that pricing helping Elevance. I mean, this we know is the artist formerly known as Anthem. So, so we know that they just have that name strength there. They have a strong position within that market. And then they also saw membership growth in Medicaid, Medicare, and higher pharmacy revenue. So that was definitely accretive.
And the street, it's pretty positive right now. There's some commentary from JP Morgan saying the beat and raise reflects strong fundamental performance and should help alleviate recent cost trend and utilization concerns. I think investors will be focused on those cost trends in the back half of the year. RBC Capital Markets also called the results solid. Both of those banks have overweight ratings on them right now. But I do think healthcare is having a bit of a moment right now, right? I mean, between pickleball leading to more insurance claims, we have the Ozempic craze, we have the FDA approving the first over-the-counter birth control drug. I mean, there's a lot happening in this space right now. And Julie, as you were just saying, the sector is up about 1% today. So
yeah, it is. Although Elevance has not done well this year. It's down about 7% or so, I believe, for the year to date. So typically, when you have people worried about the economy, they go into a place like health insurers. So maybe people aren't that worried right now. We're not seeing that kind of surge into those kinds of stocks.
Yeah, we'll see what happens to it through the balance of the year. Ali Canal, thank you so much. All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
What sector is going to perform the best during earnings?
What sector is going to perform the best? I would say probably not tech this earnings season, partially because it's run up already so far and the guidance needs to justify the valuations. Financials have done really well. We may have already seen the best sector during earnings season. I think energy actually has a good chance to do pretty well as well.
I always tell people that they should be maxing out their 401ks. And if you can't max it out, start somewhere. It doesn't matter if you start small and then you up it every single year, even 1%.
There's no question that the current economic environment we're in, with inflation running as hot as it's been for the last 2 years, has caused people to be in more of a pinch than maybe they were before.
There's two ways to really build significant wealth. One is through real estate, great investment, you get some tax advantages. Stocks are the other way. For most people, that's going to be the most viable way.
First, you've got to have savings. Second thing you want to do is really maximize your employer plan. You want to make sure you're getting the full match before you do anything else.
Kathy Wood's ARK investment funds discarding more shares of Tesla and Coinbase, but still scooping up shares of Twilio. Yahoo Finance's Jared Blickery joins us now with the details. Jared?
Let's take a look at what she's selling here. Now, by the way, Kathy Woods operates some very transparent funds in terms of disclosing on a daily basis what she's buying and selling. But the reason we don't know that much is a black box. But here's what we do know. Coinbase, there's been more selling overnight. Last Friday, all of her funds put together sold about $50 million worth. Well, another $26.3 million yesterday spread among her FinTech Innovation Fund, the flagship ARK Innovation ETF, that's ARKK. Investors know that, and the Next Generation ETF as well. Now, she's also selling Tesla, $13.1 million worth. That is over her Innovation ETF and the Next Generation Internet ETF as well. But let's take a look at some of the charts here and just see what's going on. I told you we don't know exactly why she might be selling, why she sold before. She said sometimes the price goes far enough, fast enough that, well, she wants to take some of those profits. Sometimes she can only allocate a certain amount to any of these funds, and so by her disclosure document, she has to sell a little. In other words, if it becomes too concentrated. But here's Coinbase. You can see Coinbase also up a significant amount. This is 212% year to date, and what she's selling, or excuse me, what she's buying here is actually Meta. Now, if you take a look at this chart, this is 160% year to date, far and above what these other two are doing, but she's adding to this position. Really interesting chart for me on Meta. I hadn't looked at this in a few weeks, but this is almost a perfect from the lower left to the upper right chart here with very low volatility, absent these few what look like earnings announcement days in there. So let's take a look now at the performance of her basket of funds. These are all of her ETFs, have 8 of them year to date. And the number one, not surprisingly, is centered around tech in the US. Here's a year-to-date chart. This is the Next Generation Internet ETF. Really took off in June, along with a lot of other things here. That's when it broke through these highs that we got earlier in the year. So that's up 76%. The FinTech ETF also has a similar chart, up just a little bit less. And then you take a look at the Innovation Fund, the flagship fund, similar story there too. As I've been noting, June was kind of a bellwether event. There was a bellwether event at the beginning of the month that was non-farm payrolls, changed the characteristic of the rally where we saw a lot of participation besides the mega caps that we'd seen so far. We've seen a lot of other things get sucked up into the trade, into this bullishness, and arguably, Kathy Wood's funds are on the fringe. They're on the fringe of these investments. A lot of these names were heavily shorted, and it's because a lot of these names were just so battered and bruised last year that they have been the most ripe for short covering rallies. So I think there's a little bit of all of that in what we're seeing here. Don't take too much in the daily sellings and buyings of these innovation funds, but you take a look at the net performance, it's undeniable that this is a bullish rally that we're in that has swept up finally the fringe elements, and that's really come to light over the last 4 to 6 weeks.
Just a quick note, though. When you look at RK, if you can call it up again and do a 5-year chart.
Oh, you want the good one. Here, let's relative performance, right?
Yeah.
Still way down there. They're probably the lowest decile. And that's what I'm talking about. These stocks that were beaten down the most, they're going to have the biggest, flashiest rallies, but they're still, if a stock is down 90%, guess what? You got to climb up about 900% to get your money back. So it doesn't exactly work out sometimes the way investors hope.
Yeah, it's really fascinating because investors stuck with her on the way down, but there's some reports now that she has seen some outflows even as the performance has improved.
Well, that's par for the course. Retail tends to get it wrong. It's unfortunate, but it's a maxim. Retail tends to get it wrong.
Well, hopefully they won't always. All right,
No,
thanks.
not always. There's always the future to hope for, right?
Yes,
Okay.
indeed. Well, investors are eating up Chipotle's planned expansion into the Middle East. The fast casual chain has signed its first ever franchise deal to sell its burritos in the region as it looks to grow beyond the U.S., Canada, and Europe. Peter TSLA, BTIG Managing Director and Restaurant Analyst, is joining us now. Peter, this deal caught our eye that Chipotle is planning to expand there. How big a growth opportunity do you think that this is?
Yeah, great. So thanks for having me on. So look, I think this is a great first move to expand into the Middle East for Chipotle, kind of their first major deal in going international. Look, they've got over 3,000 restaurants here in the U.S. There's really no reason, based on what we've seen from other restaurant operators, why an international markets in total can't be the same size as the domestic business. I think they have aspirations in the U.S. to get to 7,000 units. My sense is that international over time, many, many years out, could be just as large as the domestic business. So think in total, I would think, you're probably 14, 15,000 units in total if they eventually get to their aspirational goal of getting to around 7,000 units here in the U.S.
And Peter, what are you expecting for Chipotle heading into its earnings? I know they're out next week. I believe it's next week. What are you looking for from Chipotle?
Look, I think we're looking for continued momentum, especially on the traffic side. They had some positive traffic last quarter, and that's what you saw really drive this stock materially higher. I think the unit development continues to be solid in that 250, 260 units a year. My sense is that most of the development that they're going to have this year is going to come from the Chipotlanes, which are higher volume, higher margin locations. What I think investors should really start to focus their attention on really is the restaurant level margins here for Chipotle. We believe that we're starting to see some moderation in commodity prices, and I think Chipotle should start to see that on the margins, with margins outperforming, especially if they have some positive traffic that they can get some leverage on. So we're seeing some improvements on the commodity side. We're also seeing a lot of improvements on labor availability and retention, which I think is also another hidden gem that can really drive the margins higher for Chipotle.
Peter, speaking of those margins, though, and speaking of high volume, there's also a report in the in the Wall Street Journal that Chipotle is also refocusing its attention on smaller towns, right? Lower size markets. And that would imply maybe they're not going to get that same traffic there. Do you think that's a good strategy?
Yeah, look, I think most of their development is coming with Chipotlanes, which are going into more existing markets. So they're dipping their toe into some of these smaller markets. We've heard that from several other operators as well. Look, if you want to grow and you want to be a national brand, you got to go into a lot of these smaller markets. I think they're going to cherry pick some of the best locations, but in total, I do think the majority of their restaurant development is going to be in larger markets with Chipotlanes that can sustain, higher volume. So I don't see this as a risk. I see this as just another leg to the growth strategy going forward.
Peter, let's pivot to pizza. You're a fan of DPZ, and you set a price target on it for $4.65. What's your case for this?
Yeah, so we raised our price target this morning. We raised our estimates. We're about $1 above consensus estimates for 2024. We believe that same-store sales can accelerate into the mid-single-digit range on the heels of the Uber Eats partnership that they just announced and will launch later this year. Again, look, a mid-single-digit comp benefit. And I think in this environment, will drive a lot of their delivery sales. In addition, we're also seeing, like we just mentioned, we're seeing commodities coming in, primarily cheese. Cheese is down around 25% so far this year. And that is the bulk of their commodity basket. It's about 35% of their commodity basket. We're also seeing improvements in labor availability in terms of driver availability, which they did not have last year. Last year, they were closing stores early, opening later because they couldn't fill the driver position. This year, they don't have that problem. So they should have more operating hours as well. So when you put all that together, I think franchisee economics are improving. That's going to drive accelerated development. And I think that will drive the shares higher.
And do you think when it comes to Domino's that they're really outplaying the competitors as well? I mean, their share price is up this year, but it's not crazy up. But if you look at some of the other pizza stocks, they have done worse.
Yeah, look, I think when you look at Domino's, I think you got to compare them, yes, to other pizza names, but you also got to compare them to other large cap names. If you look at the large cap restaurant operators, McDonald's, Yum, Chipotle, Darden, they're all at or near all-time highs. Domino's is about 40% off of its all-time high. I still think, in our view, with this inflection that we think is coming over the next couple of quarters, we do believe that this stock can inflect higher and move in line with the rest of the peer group back up towards those all-time highs. So I think there's a lot more room for this stock to run. We're pretty confident that, as same-store sales improve, you'll see that the profitability of the franchisees improve as well.
But Peter, can comps hold up if there is, I know there have been reductions in forecasts of a recession. Can the comps still hold up in the face of that?
Well, I would say in an environment of a recession, I think pizza is probably the better place to be. You can feed a family of four for $30, $35. Can't really do that with any of the other brands. Mm-hmm. So look, in a recessionary environment that's driven by consumer demand going down, it's not good for anybody. It's not good for any of these restaurants. But I think pizza will perform relatively better only because it's a cheaper, more value-oriented category.
Everyone loves pizza. That's the bottom line. Peter Saleh, it's always good to see you, BTIG Managing Director and Restaurant Analyst. Thanks, Peter.
Thank you.
And let's take a look at one trending ticker that we are watching today. Shares of VMware getting a boost this morning after chipmaker Broadcom's $61 billion bid to buy the company cleared another roadblock, with the UK's competition regulator giving it the green light. The final report from the Competition and Markets Authority will be issued on September 12th, and those shares are moving higher by almost 6%.
All your markets action ahead. Stay tuned. You are watching Yahoo Finance.
As you pointed out in a recent note, you've been doing this 19 years now. I think you and I have probably been doing it about the same amount of time. What is the biggest lesson the markets have taught you in that time?
That's a great question. So I say this to kids that I mentor all the time. I say this to young professionals. The first crisis you go through, the first bear market you go through, shapes you. And the first one that I was really in it for was the 2007-2008 crisis. So I am obsessed with credit. I'm obsessed with spreads. I'm obsessed with lending, right? And watching all of those indicators. This particular market cycle has taught me that although all of those lessons are still important and important to remember, the investor base has changed, and the reaction function, the quickness with which we react to things has changed. So you do have to continue to be moldable throughout your career. No matter how much experience you have to continue to be moldable and allow for those changes in who is actually putting their money to work.
It is just after 10 a.m. in New York City. This is Yahoo Finance Live. I'm Diane King Hall alongside Julie Hyman. We're about 30 minutes into the trading day. Let's take a look at how stocks are moving. Now, the S&P 500 notching gains this morning with earnings season well underway. Of the companies in the S&Ps that reported results so far, 78% have exceeded expectations, but we still have a long way to go.
Indeed, we do. We are watching shares of Goldman Sachs on the other side of the ledger. The share's relatively flat right now. The Wall Street giant missing on profit last quarter thanks to hits from consumer lending and real estate. The drop far from a surprise, however. Goldman did repeatedly warn of lackluster results ahead of the earnings.
Also, keeping an eye on Tesla. Earnings to come later this afternoon. Investors will be laser focused on the EV maker's profit margins, which took a hit last quarter on price cuts. Now, Tesla has enjoyed positive headlines of late, including charging deals with auto manufacturers, solid delivery numbers, and the production of its first Cybertruck.
And shares of Netflix, they are down just about 0.75%. The streaming giant set to report after the bell today. Subscription gains from the company's password crackdown will be in full focus. Investors also watching for any insight on how ongoing Hollywood strikes could affect the company. Well, Microsoft and Activision have secured an extension to close their $69 billion merger deal amid talks with UK regulators. With more, we're joined by our own Dan Howley. This thing has had a lot of twists and turns, and now it looks like they're getting a little more time.
Yeah, a lot of ups and downs here. The original deadline passed yesterday. That would have included a $3 billion breakup payment that Microsoft would have had to pay to Activision Blizzard, but we don't have a deal. So now the companies have agreed to a new deadline. That is going to be September 15th, but there's going to be one in August for August 29th as well. If they don't get the deal done by then, it would be $3.5 billion. If it can't get it done by September, it would be $4.5 billion. So a lot riding on this getting done within the next month. And so, overall, both parties say that they're optimistic. We have Activision saying the recent decision in the U.S. and approvals in 40 countries all validate that the deal is good for competition players and the future of gaming. And then Microsoft's Xbox chief, Phil Spencer, basically saying, look, we can get the deal done now in the U.S. technically, while the FTC kind of does its own internal action, but they want to just kind of wait, get everything sorted out with the UK. So does this mean that the deal is going to go through? We're still not 100% sure, but it's looking more and more likely that this will happen. It would be the biggest merger or acquisition in the gaming industry ever at $69 billion. So absolutely massive, and would put Microsoft as the third largest gaming company by revenue in the world. So just behind Tencent and Sony, it would be a big jump for them, especially after years and years as kind of being like the not even second but third banana. So it's
All right. Well, let's talk about something else in your wheelhouse. We'll talk about the chip space. Chip equipment maker, specifically ASML, reporting its results today, seeing orders surge amid rising demand in China. So what do you make of this, especially when you think about the broader chip space, Dan? Yeah,
so they raised full-year sales growth forecast to about 30%. That's up from 25% in the prior forecast. And, it's interesting. What ASML is saying here is that it's not its top of the line equipment. So ASML, just so everybody knows, is an equipment manufacturer that provides the equipment that chip makers then use to build chips. They're saying that their ultra high-end stuff, their extreme ultraviolet systems, the demand for that isn't exactly where they would like it to be, just because companies like TSMC, Samsung, and Intel are building out the plants that will eventually need these kinds of systems to build chips. Meanwhile, over in China, they're still getting the deep ultraviolet devices, the systems that would put together chips. They're not as high-end as the EUV. That's because of the whole sanctions and regulatory requirements now going through China. So they're getting that second level kind of production capability. They're seeing those pick up, though. And that's just because the demand, as you said, in China is rising. And so what does this mean for the rest of the chip industry? Well, we kind of have to see. It means that, obviously, despite demand going up in China, it's not going to be the super high-end stuff from these companies. So, We'll see what it means for Intel, NVIDIA, AMD, Qualcomm, all these other companies when they report their earnings. But on the PC side of things, where AMD and Intel have just been taking it like punches to the face, there was a report from Gartner saying that the downturn might be going up again. So we might be seeing an end to that downturn, though there's still a decline. It could start to even out maybe around 2024. So still not great for the immediate future, but eventually things will get better.
Light at the end of the tunnel.
Yeah.
Dan Howley, we appreciate you making time, especially before your big trip you have coming up.
Thank you very much.
All right. Thank you so much. Big banks have delivered their Q2 earnings, and the landscape is better than expected. The higher interest rates boosted the bottom line for many large lenders, though other income streams like investment banking took a sizable hit. So what's the smart financial play for your portfolio? John Curran, Principal Asset Management Portfolio Manager, joining us now. So what is the smart play in light of all the results that we have received, John?
Well, good morning. It's great to be with you. I think the smart play here is to stay in the large, liquid, diversified banks that have a nice blend of fee and interest income in their top line. I think the results really highlight the importance of diversification, and the big banks have shown themselves to be a bright spot, and that they're resilient and they're deft handling the deposit rates amidst the higher rates.
Hey, John, it's Julie here. So in your portfolio, which of these do you hold the most of, or what are you adding to right now?
Well, we work on the bond side, and we look for the large liquid balance sheets, good access to funding, not just on the deposit side, but on the access to the debt markets. And one of the big surprises this year, one of the wild cards, has been the debt issuance, which last year in 2022, January saw $29 billion of debt issuance. This January is $9 billion. This quarter really is the first quarter of material bond issuance, and we've seen a lot of it. So we're looking for the banks that have durable deposit bases, but that also can access wholesale funding markets and have the investor receptivity that they do.
And John, then who would you be dumping in light of that when you use your investment thesis?
So I think general good diligence wins the day here when you're considering bank investments. It's really important to do your homework, know the management teams, know that they're making good underwriting decisions. There are headwinds on the horizon. The recent Fed loan officer survey did show some contraction in lending standards and lending overall. But the big banks have been very resilient in passing through some of those rates in the form of loans to their customers while lagging the increase in deposits. They can do that because they're blessed with these large deposit bases.
What about the non-big banks, John? We heard from some of the regionals today, and it looks like that they're holding on, by and large, they're holding on, or even in some cases growing their deposit bases. They're having to pay up to do so. Is the debt of those banks as attractive?
Well, I think you make a very good point. I think the recent results of the big banks really shows the widening gulf between the haves and the have-nots. The gigantic banks, the money center banks, which are positioned very well to withstand headwinds and any turbulence that may be coming down the pike, and the smaller regional banks. It was heartening to see some of the really large regional banks like PNC, Truist, and U.S. Bancorp come to market in June. That opened the gate for regional banks, but we haven't seen regional banks writ large be able to access the debt markets yet. So I think we need to just see a bit more earnings stability and a little bit more how firm or how well footed their deposit bases are before we get some sense that they can persist with success like their large bank peers.
John, with more regulation coming down the pike, pretty much imminent, are you expecting to see more consolidation? And who do you see kind of in the, like we saw JP Morgan Chase getting bigger recently because of that consolidation? Who do you see being a target in that situation?
It's an excellent question to see where the next tie-ups will occur. I think you have to look for symbiotic deposit footprints that are complementary in nature. You did see the 2019 merger between BB&T and SunTrust that formed Truist. To have a transformational merger like that might make sense, but it will depend on where the deposit concentrations are the largest. But I think clearly the large banks have shown themselves to be ones that can persevere through this environment. So the larger the banks, the more levers they have to pull, both in their top line and their funding businesses. And just if you look at their concentration risks, I mean, commercial real estate is one of the headwinds out there for these banks, but the large money center banks are much more insulated, not impervious, but more insulated than their smaller peers.
What about just the general headwind as well from decrease in lending demand, sort of across the board, whether we're talking about businesses or individuals?
Mm-hmm. Yeah, I mean, we did see the contraction in some commercial and industrial, as we like to call it in the industry, C&I lending, the recent Fed loan officer survey. I think that's clearly one of the headwinds that we've noted that's on the horizon. Nonetheless, JP Morgan and Wells Fargo did say that their earnings they expect to make from loans is increasing. So it's a bit of a, on the one hand, there is probably some contraction ahead and some credit tightening, but on the other hand, there is still demand. Citigroup actually posted a surprisingly large jump in their credit card revenues, and they're the bellwether. The one thing you have to worry about or just be cautious about is if the more borrowing that occurs on plastic, the more the banks have in terms of their loans. So that's one thing we're watching, keeping a watchful eye on.
Yeah, and indeed we're seeing the provisioning for that kind of stuff start to creep back up once again. John, thanks for your perspective. John Curran, Principal Asset Management Portfolio Manager. Appreciate it.
Thanks very much.
We got much more coming up. You're watching Yahoo Finance. What is your favorite chart or indicator right now?
Favorite chart or indicator? I mean, it doesn't signal good things, but I continue to be kept up at night by the yield curve inversions. They've stayed really deep. They've been here for a long time. They don't usually signal clear skies ahead, so watching that for what happens when they start to re-steepen, that usually does inflict pain on the equity market.
Let's do a check of the markets now, sponsored by Tasty Trade. We are seeing all three major averages in the green. Not seeing huge gains today, but the Dow leading the way here, up about 2/3 of 1%. A couple of things standing out to me. Goldman Sachs, which of course we've been tracking all day on earnings, it was kind of wavering earlier in the day. Now it's up about 1.5%. Crude oil taking a leg up as well. So some interesting different assets that we are watching in today's session. Quick. What do you do in April 15th, 2024? Hopefully not waiting until that day to file your taxes. That's right, we are halfway through this year, and that means you should start thinking about the tax deadline. Don't stress, though. A Yahoo Finance Twitter poll found almost 60% of respondents have not thought about next year's taxes at all, which is frankly surprisingly low to me. I would have thought it would have been higher. Our next guest says it's worth doing a mid-year check so you are more prepared when the season rolls around. Mark Stieber is a Senior Vice President and Chief Tax Information Officer at Jackson Hewitt Tax Service. He is with us in the studio. It's good to see you.
Good to be here.
So what's the number one thing mid-year that you need to be thinking about when you're casting your mind to taxes next year?
Well, a lot of people say at the end of December, hey, give me a tax tip. I want to save on my taxes. What's the thing? And I say, well, if you'd have talked to me in July, I'd have given you 4 or 5 things. These are the 4 or 5 things. And I'll start off by simply saying, if you weren't happy with last year's result on tax day, if your refund wasn't like you liked, or you, worst case, owed a balance due, or even worse, you were expecting some money, now's the time to take account on that. Now's the time to take half a year of your information, just as simple as your pay stub, multiply it by 2, look at your withholding, multiply that by 2, adjust for other life changes, and we'll get to that in a moment, and kind of see where you are. And odds are you're going to be kind of like last year. So if you weren't happy last year, you're probably going to be unhappy this year. On the other hand, if you were really excited and you got a great one last year, you want to double check and make sure you're on track for that this year. But just waiting and rolling the dice and saying it'll happen, that's not your best idea for your largest single financial transaction every year, your tax return. Sure, you buy a house, sure you may get married or divorced or have a child, but your tax return's here 30, 40, 50 years. Give it some best practice attention and you'll be happier.
They do always say, it's one of life's inevitabilities is taxes. But so you mentioned a refund. They, financial experts that we talk to always say, you shouldn't be aiming for a refund. It sounds
I've had this debate with many academics, many philosophers, many notable smart people, and I tell you now, as a 40-year veteran, a big tax refund is a good thing. It is not a bad thing. If you spend it wisely, you pay down debt, you buy some of the things, you celebrate it a little bit with your family. But it is not a bad thing. In fact, for most Americans who can't put that $40 or $50 aside, they go to Starbucks, they go to Twitter, they TikTok, or they spend it wherever. Having a $3,000 or $4,000 refund put aside for you is a good thing. Sure, you don't have the use of your money, but in recent days, if you had it in the stock market, you were losing anyway. Now, granted, we're up now, but the point is, it works for a lot of Americans. And 3 out of 4 people have gotten a refund, not out of ignorance, not out of stupidity. They didn't not know what was coming. They like it that way. Now, back in 2020, the IRS adjusted them down. That's why we had a lot of refund disappointment, refund shock, and balance due trauma over the last 2 years. They've really started to pull back on that, thinking people would be better off. I'm here to tell you, many people are not better off. We had a lot of people who couldn't pay or didn't have the money or were counting on the money, and I saw the pain at the desk. Take account right now, adjust your withholding, change your W-4. It's pretty easy at most companies on your HR platform. Add another $25 or $50 to your withholding. It's a smart thing to do if it works for you. Now, on the other hand, if you're getting a big refund, $10,000, $5,000, you might be better used to that. But the worst case is not knowing and just hoping that tax guy gets it right at the desk. And oh gosh, I owe and I don't have it. Or I was counting on $4,000 and I'm not getting it. Plan now, plan for the next 5 months. It'll be here before you know it.
Speaking of planning, you mentioned before life events, right, that can affect your taxes. Getting married, having a child, buying a house. How should you be? Most of the time, people don't necessarily think right off the bat about taxes. Like, I just had a baby, I'm thinking about my taxes. No.
It's a deduction.
What do they need to be thinking
Well,
about?
the simple fact of the matter is we talk about tax changes and tax law changes and late changes. Life changes drive bigger impact on your tax return each and every year than tax law changes. First of all, they're more common, and secondly, they don't get the high profile publicity. Getting married is huge. If a man and a woman or 2 men or whoever gets married and you add their incomes together, it's not just 1 and 1 is 2 for your taxes. You generally go into a higher tax rate, you may phase out of benefits, you're generally in a much, much different position. So if you're thinking about getting married or you got married, you really need to do a mid-year checkup. Had a child, there's a dozen different tax benefits that you might not even know about. and that can help you out. Education benefits. You start a side gig. We saw this in the pandemic. A lot of people had to do it to make ends meet. A lot of people found out they were good at it, or they liked it, or they're continuing to do it. But when you've got a side gig, it's a totally different animal than working for an employer who withholds the money. You have to pay the Fed tax, the state tax, the Social Security, the Medicare. And if you find out at the tax desk you had a pretty good year, but now 20 or 30 or 40% go to the man, that's not a very favorable experience. So anybody who had a life change, big, medium, or small, got married, had children, got divorced, side gig, cryptocurrency, all of those have a big impact, and generally a non-happy impact at the tax desk.
I like that cryptocurrency is a life event. I'm just laughing at that. I guess for some people it is.
I got to ask you, in terms of like what is the most beneficial move to make if you're trying to decrease the amount you owe? Like what is either the purchase you can make or contribution to, like, let's say your IRA? What would you say is...
That's a great question, and the fact of the matter is there's dozens of best practices. The one I always tell folks is if you're an employee and your company has a 401k and they have a matching, which many do, if you're not at least contributing to the 401k to the extent you get the match, you're missing that benefit. Plus you're missing the tax deductibility of your contribution, plus the tax-free growth. So 401k as an employee, and a similar thing if you're self-employed, is a number one go-to. But if you've got kids or dependents and you have education costs, there's a dozen benefits on education. And if you're self-employed, it's Katie bar the door, there's so many benefits. And a lot of people just track their money. How much money? How much money? And they don't keep good track of their expenses. And at a minimum, you should have a journal and keep track of your expenses.
Or an app.
Or an app is even better, but I'm not going to ask a bridge too far. Keep track of your expenses. It reduces your taxes. And don't just try to remember them when you're with your tax person. That's a poor way to go to cut your taxes. And so self-employed, 30, 40 million people now after the pandemic doing it, not all doing it good. They too need a mid-year checkup.
So when you talk about the mid-year tax checkup, what is the best way to do it?
The beauty is it's whatever you like. At a minimum, you should take last year's tax return, print it out, take your June 30 pay stub, write in the margin, I made $20,000 up to June, I double it, 40, adjusting for bonuses and other things. I took withholding $4,000 through June, double it, $8,000. And you can kind of do it right in the margin of your paper tax return. Even use last year's tax rate just for a rudimentary one. There are great tax engines on jacksonhewitt.com. You can put all this in and see how it is. But at a minimum, you just plug in the big parts. Then go as big as you like. I use an Excel spreadsheet. I do a June 30, multiply it by 2, kind of adjust for other things. Kids have aged out, no more dependent, and see where I am. And if it's where you are, then fine. If it's, oh gosh, that's not what I expect, then you might need to escalate and get a pro to go, well, no, you've misunderstood how that works. Or, oh, no, good, you do have a dependent. You do get child credit, dependent care credit, earned income credit, or whatever else might be adjusted for the life changes that you've had. If it's just vanilla, which I'll tell you, that's kind of like a elf riding a unicorn down the rainbow these days. Everybody's got life changes. Figure what it looks like and avoid refund disappointment, refund shock, or balance due trauma. We've seen all those the last couple years.
Balance due trauma. Oh, it's not fun. All right, Mark Stever. Oh, we appreciate this so much. Chief Tax Information Officer at Jackson Hewitt. Thank you so much.
Thanks for having me. Good luck on that Powerball. Then you won't have to worry about it.
Right, exactly. We need to do a pool.
We gotta do it.
All your markets action is ahead. Stay tuned. You're watching Yahoo Finance.
Barbie or Oppenheimer? Or both? Because there are some people who are doing both, apparently.
Yeah, I like Barbie. I'm a Barbie gal. I've always loved Barbies. Even when I was little, I had the Ferrari, I had the pool, and they were my favorite.
Me too.
Well, apparently the bull run for stocks won't last long, at least according to our next guest. Citigroup's Scott Cronard is maintaining his 4,000 year-end target for the S&P 500, saying the AI growth move needs to be digested and establishes a stronger first half of 2024 with a 4,400 target. He joins us now. Scott, so thanks so much for joining us. First, let's get into this target. I mean, we are a ways from that right now. What is the trigger that starts that downtrend?
Well, I think going into the second half, we've had this strong rally, let's call it in the Nasdaq names. And, typically when you see a rally of that magnitude, there is some point where you need to digest the move as you're waiting for the earnings revisions to catch up. At the same time, we've gone into the second half thinking that the probability of recession or recession characteristics kicking in a response to the Fed actions over the past year actually would end up putting a headwind on earnings growth potential. So the face-off of those two basically said, look at strong move to start the year. We think it's premature to say it's a new S&P bull market. We look for a pullback to buy into on the premise that as we look at the first half of 24, the picture begins to get much clearer in our view, and so we can get more constructive at that point. So color us glass half full on the equity outlook from here. We're just preferring to buy more aggressively on pullbacks.
I guess, hey, Scott, it's Julie here. What is going to trigger those pullbacks? I mean, listen, we're only, a few days into the earnings season, but so far, if not sunshine and rainbows, it's been pretty darn good, right? We've heard this sort of resilience language being used on the part of CEOs. How do you think that's going to play out as we go through earnings season?
I would say the earnings resilience concept is one that we've been using as well over the past year or so. We used it last year. We're still using it this year to kind of frame out how to think about recession risk. But, I think the underlying all of this is the fact is that the more you run these stocks, the higher the implicit expectations become for companies to deliver incrementally from a fundamental perspective, okay? And we don't doubt that AI is going to be a big thing structurally over the next several years. It's just a question of navigating the shorter term lens where you've had big moves. Will the incremental data points on these heavy NASDAQ weights be sufficient to keep it going? And I think that's sort of the rub. Now, what this does is put a lot of pressure on our view next week, actually, when the bulk of these companies report. So, we'll be checking in on the other side of that, but I think that's going to be the next important set of data points for us.
So, Scott, if your thesis is correct in terms of where the S&P 500 is headed, what is the best defensive position for that?
This is going to sound crazy, but the best defensive position in our view is offensive. And namely, what we've been, suggesting for the past couple of months now is hold those big tech names. Okay, they're running. Again, there's this new AI catalyst that's unfolding here. Got that. Put new money to work on the cyclical side of the market as opposed to defensives. So we're less interested in the traditional defensive calls that worked last year, which we're much more interested in putting money to work incrementally in areas such as industrials, materials, and so forth. And here what you get is, again, our ongoing resilience, earnings resilience argument in those sectors, but you also get the play that should recession continue to get pushed out or eventually become soft landing, ultimately these companies stand to benefit. In aggregate, the cyclicals are up only a couple of percent year to date, whereas the growth component of the market's up 40%. And so we're very confident that for new money, you want to focus on the cyclical side of the market.
And what do you do with tech, Scott? What do you do with growth, that area that has so outperformed? And as you say, we're coming up on those earnings as well.
This is going to sound like a cop-out, but you hold them. Like I said, I do think that longer term, the way we're thinking about this AI construct, and let's focus on that for just a second, is that they're going to be companies that have a very clear revenue and earnings benefit from that as they launch new products specific to this generative AI construct, okay? On the other hand, the broader marketplace and broader economy may not be a revenue earnings beneficiary, it may be a productivity beneficiary, okay? So essentially, when it comes to these, the mega cap growth names, we're gonna see them launch new products. You're beginning to see that already. We wanna be on board for that. Again, acknowledging they've run, maybe due for a pause or a pullback, but longer term, we think that it's pretty premature to say it's over for those names. And I would just add the added element that we still think there's room for whether you want to call it performance chasing or other areas of investor money to come into the market. And so again, it's a hold call, doesn't sound super exciting. Prepare for a pullback, put new money to work on cyclicals, and prepare for, in our view, a bit more of a coast is clear heading into the 2024 timeframe.
So in your notes, you all say your base case for the second half of 2023 is biased toward a growth slowdown with a lower probability of recession. So how is that the framework that we're speaking of right now? And what sectors are you going in or focused in with that in mind?
Yeah, so this recession timing is the big issue in my mind. Apart from the mega cap growth, AI related surge, recession timing is the big discussion. And, you know, a year ago at this time, our view was that we would be looking at recession concerns in the first half of 23. We saw those on the manufacturing side of the economy, quite honestly. And you see many C-suites going back to Q4 and Q1 reports on the manufacturing industrial side saying, hey, look at this, looks and feels like recession conditions. You did not see that and have not seen that as much on the services or consumer consumption side. And ultimately, when you look at what the Fed's trying to do with its interest rate hikes over the past year, it's really to slow consumption in a way that essentially tames this inflation concern of theirs. So as we go forward from here, the question always comes up, recession. And my response is, why do recessions matter? Recessions matter because they have an earnings influence or impact. You typically get an interest rate response that leads to a valuation resolution in the marketplace. And at this point, what we're still debating is this notion of the Fed slowing economic conditions, getting it fully reflected in earnings expectations before we can begin to talk about the Fed on the other side of the rate hike cycle. So recession timing becomes a big deal. City House view has been pushing out. We were, first half 23, then second half 23. Now they're out to the first half of 24. So we have this issue kind of out there lurking in front of us that we have to navigate while we're trying to, also consider the possibilities of this mega cap growth regime shift.
No sweat, right? Scott Kroner, thanks for being here. Citigroup U.S. equity strategist. Good to see you.
My pleasure. Thanks, guys.
Got much more coming up. You're watching Yahoo Finance. What sector is going to perform the best during earnings?
What sector is going to perform the best? I would say probably not tech this earnings season, partially because it's run up already so far and the guidance needs to justify the valuations. Financials have done really well. We may have already seen the best sector during earnings season. I think energy actually has a good chance to do pretty well as well.
An indicator of U.S. residential construction fell below Wall Street expectations in June. The slowdown was felt on new single-family home sites, dropping to 935,000 units. Yahoo Finance's Danny Romero joins us more with what this means ahead of home builder earnings.
Yeah, this month was a slump compared to May's numbers. Builders are sharply slowing down their housing starts, which impacts both single family units and multifamily units. So if we take a look at the numbers, the seasonal adjusted annual rate came in at 1.4 million units in June. That is down 8% from May's figure of 1.5 million units. The biggest takeaway from this report, though, is the fact that single family units are down about 7% over the last month, but building permits are up about 2%, and that is an indicator of future housing starts. There's still a lot of single family and multifamily units under construction right now, but not much of that supply has been added to the housing market. The number of completed homes is still down. And builders really do have an advantage right now in today's market, despite mortgage rates hovering around that 7%.
So speaking of home builders and what they've been doing, we're going to start to hear from them in terms of earnings. So what do we need to be paying attention to when it comes to the home builders and what they're going to say?
So there are three stocks that are on deck. We got D.R. Horton, Meritage, and Pulte Group. So let's start with D.R. Horton. They're about to release their third quarter earnings tomorrow before the opening bell. Wall Street is really looking for additional commentary on the current market. So how is demand doing this summer? What are the starts pace? Are there any impacts on margin given the prices of lumber? And are there any shifts in appetite? Meaning, are people buying or preferring to rent right now? But if we move on to Meritage, the fifth largest home builder, they're set to release second quarter earnings next Thursday. And analysts are keeping a close eye if that home builder actually met its targeted goals on their sales pace of 3 to 4 months this summer. And any updates on pricing and incentives, because that can also impact margins, and any color on their progress of new developments. And just to wrap it up real quick, the next one is Pulte Group, which is also set to release earnings next Tuesday. And investors are really looking at the demand between specs or build to order progress there, despite mortgage rates hovering around that 7%.
I assume build to order maybe has better margins. I don't know.
Well, and that's an interesting aspect that a lot of investors are really looking at, because specs are before they're even developed, before they're even in the ground. So it's good to see, are people anticipating that rates will go down? But also Pulte Group is offering a mortgage, a rate buy down of about 5% right now. So there's some incentives there right now. I just was taking a look at that earlier today.
All right. We got to put a pin in this conversation. Danny Romero, we appreciate both the information, and I like the orange. We got the memo. All right, Danny, thank you. The return to office movement picking up steam as more companies mandate a return to in-person work. But what does a recovery truly look like for the space? Our Akiko Fujita and Shauna Smith spoke to John Gates, JLL CEO of America's Markets, yesterday to get a pulse check on the industry. Here's what he had to say.
The thing about the recovery is it's been very, very methodical, right? On a monthly or quarterly basis. Then we've had some cyclical challenges impact that as well. The secular change where every office worker almost in the world went home in a span of 2 weeks was wildly abrupt, unprecedented, sort of in economic history. So it's been very methodical, but we do see positive signs in the data.
John, do you think we're going to get back to those pre-pandemic levels? And when you talk about the timeline of that, what does that then look like?
We're a couple of years into it, and I think it's perhaps another year. You all just cited the data where there's been actually closer to 1.5 million office workers have had company policies change to return to office for portions of the time, and another 1 million yet to come this year. That's a lot of space, 2.5 million workers, and they're going to occupy at least 100 million square feet, at least a couple of days a week, just as an example. That's a very healthy metric, and it helps get closer to stabilized equilibrium markets, as I said.
You've pointed to leasing activity picking up. What are some of these companies seeking? I mean, we have heard anecdotes about offices, businesses, for example, considering short-term leases because, yes, they want employees to come back, but they don't know how many will come back. They don't want to go for the long-term leases that maybe would have persisted before the pandemic. What are you seeing?
We're seeing just about everything you could imagine. Business people are creative, and so somewhat shorter term space, almost universally new and highly amenitized space. So the absorption figures and the leasing figures for office buildings that were delivered in 2015 or more recently have been actually pretty healthy the last couple of years. It's the older product that's not as shiny, it's not new, and it's not as highly amenitized unless it's been completely redone, where they've really lost a lot of tenant base. Some do want shorter terms. As you know, commercial real estate assets are, the capital stack is long-term capital, so there's only so much room for shorter term income streams around those assets. So some of that gets done, and then a lot of times, if you want to be in the right building, you're going to sign a lease that might be 7 years or 10 years or even longer.
John, who is signing these leases? Can you point to a specific sector where you're seeing the most activity, or are you seeing industries across the board bring their employees back?
Both. I mean, you tend to see surges in industry sectors, right, to your point. So in Q1, financials had a pretty big surge. In Q2, energy and utilities have had a pretty good surge. There's a nice, in the scheme of the overall market, it's a little bit of a blip, but it won't surprise you that we're tracking over 1.5 million square feet of requirements for new artificial intelligence companies, and about half of that is in the immediate San Francisco area. So we see all industries methodically recovering, but yes, in any given quarter, you absolutely see an industry surge.
That was our Kiko Fujita and Shauna Smith speaking with John Gates, JLL CEO of America's Markets. Travel is surging in the United States in these summer months, but from staffing shortages to funding challenges and severe climate-related issues, the Federal Aviation Administration is facing numerous problems that it must address. And two separate FAA bills are hitting the House floor for a vote this week, which are meant to address some of those issues. They're both expected to be slowed down by a number of issues, and with a significant amount of time built in for amendments to be added. More than 300 amendments, in fact, are up for consideration. Let's bring in now Boyd Group International President Mike Boyd to discuss more. There's a lot to consider here, Mike. Among things, changing retirement age for pilots, changing the amount of time they can spend flying, et cetera. When it comes to pilots, what do you think is most important here? What are people paying the most attention to?
Having any change in the pilot hours rule, 1,500 hours, which makes sense, except there's no responsibility for saying what that training would be. But this both of the bills, and we've looked at both bills in detail, 800 and some boring pages of them, and you're looking at a lot of things in there that are just pork or things that don't make any sense. Some Congress people want to regulate the pay of the people who clean airports. That's not even aviation. So cutting down to it, I think we're going to have pretty much what we had before. There's not going to be any major changes the consumer is going to notice.
Well, what is necessary to pass through? I know there was also a letter sent from both the CEOs of Alaska Airlines, American and United, to the House saying they're concerned about the FAA bill, concerned it's being derailed by kind of efforts to just change slot and perimeter rules. What do you think of that?
Well, that's the issue of Washington Reagan National and how far you can fly and how many long haul routes they can put there. That shouldn't even be part of this right now. That should be out of it. That's a separate issue. It's an important issue, and everybody has an opinion on it. But that should not be in this bill to hold it up at all. That should be looked at separately. It's very parochial, and quite frankly, it's just really not professional.
So what do you think is going to be the outcome of this bill when all is said and done, given that there are all these maybe parochial things thrown in?
Well, for us mere mortals out here in TV land, it's not going to make a whole lot of difference one way or the other. There's a lot of pork in it. They're not changing the things they need to change, like wasting money on essential air service to fly to places people don't go anyway. Grant programs like that. But if you look through it, there are so many little codicils, and every congressperson, it seems, has their own pet ones they're trying to slide into it. So I think getting into conference on these two bills is really going to be quite an interesting shootout.
And Mike, I want to ask you though about one of the challenges that you see as a traveler and in us covering this. We've seen a lot of issues with just the reduction in the number of flights. Is there anything in these bills that addresses kind of opening up more airspace to these airlines?
Well, they're not cutting back because of lack of airspace. We got lots and lots and lots of airspace. What's happening is they're cutting back because our air traffic control system is so poorly managed, it can't handle the situation. United just got 7,000 flights out of its Newark schedule for this fall because the air traffic control system can't handle it. It's gotten worse and worse, and all we get is pablum on that. So that's not going to improve anything. But it's not the airlines or airspace, it's a problem, even pilots. It has to do with an air traffic control system that just, frankly, is politically managed rather than functionally managed.
And how does one fix that? You know, we've talked to the Secretary of Transportation, and he's talked about the need to fix it. So where does that need to come from?
In 1994, a partner and I testified to Congress on this, and the discussion is still pretty much the same. You know, Buttigieg comes out and talks about he's going to hire more people, do this, do that. The real issue is we got to depoliticize the FAA. The last person nominated had no qualifications whatsoever. We need to find someone who can really run the place and know the business. But as long as politicians like Schumer and others get involved and try to put political hacks in there, it's just not going to work. We don't have a future for it.
One thing that I know this is not kind of as much a part of this conversation, but it's something that that the Biden administration has talked a lot about is the junk fees, like baggage, et cetera, et cetera. Has the government done enough with regard to that?
Well, they're putting out, quite frankly, jive saying you got to disclose everything. Go on any website of any U.S. carrier, they disclose everything today before you hit that button. So that argument that you'll get sudden fees that you didn't know about, that's just not true. I don't know why they keep pushing that out. Now, there is a move to say, let's take taxes out of that. And I agree with that. Let's show people what they're paying for air travel and then show them totally separately how much they're paying the government in taxes. That would be a fair way of making it happen. A lot of politicians don't want to posture taxes as taxes, but as part of the cost of flying.
Speaking part of the cost of flying, of course, there's also what people need to pay the pilots, what the various airlines need to pay the pilots. We just had the United union coming to an agreement. Now there are reports that American, which was about to ratify its agreement, is looking at United and saying, wait a minute, we want a better deal because of what they have. Where kind of are we in terms of the balance of power between the pilots and the airlines?
Well, there is a balance. It's not like one side of having been involved in labor relations, neither side holds all the cards. And in the case of, say, Americans pilots, I think they'd rather dive into the ocean than to go on a strike. But if they have to, labor unions will do that. I think they'll settle. Obviously, they'll go back to the bargaining table, tweak things up to what United has. Then they'll sit there and hope somebody else doesn't come out with a richer contract. They all have to go back. Remember, United's contract is, I think, the second or third one they supposedly have agreed on. So we don't know yet.
What about American Airlines and the potential for a flight attendant strike there? What is that something that is seriously possible? And what would that do? Would the ripple effect be to the industry?
Well, at this point in time, it's part of the bargaining process. You put that out, say, we're going to have a strike vote, but to get from a strike vote to an actual strike, there's a lot of moving parts on that. But it does show the company that the flight attendants are saying, enough of this, we want to get down and get serious. It's part of the program. The last strike American with flight attendants was 92. Mm-hmm. So I don't think you'll see one this time. They'll settle, but I think that's part of the process of saying, look, we'll go to the wall if we have to.
Mike, good to catch up with you. As always, a valuable perspective on all this stuff. Mike Boyd, Boyd Group International President. Appreciate it.
Thank you.
And sticking with aviation, shares of Joby Aviation are plummeting today, down 12% after JP Morgan downgraded the stock from neutral to underweight, citing a, quote, largely overblown rally for shares of the electric aircraft company. They've been up over 160% year to date. There's a little bit of a meme vibe, if you will, that has affected Joby, but the shares are down today. And we've had some big IPOs
Yes.
so far this year. Kava, Savers Value Village. There's another one that's coming today. It is Oddity.
I know.
Which raised $424 million in its IPO. So another one here. And what's been interesting, a lot of these have been consumer facing. Right. But the pace of IPOs is still lower this year.
It is. Although we were expecting the appetite to grow, especially when you saw the demand in that Kava IPO. And we I had an interview with the president of the stock exchange this week and talked about kind of IPO activity and, looking for that to pick up. So we're starting to kind of see that open up a little bit more. I'm looking forward to your interview that you're set to do today.
Yeah, I'm going to talk to the Oddity CFO, Lindsay Drucker-Mann, about that IPO today. Initially, we are seeing relatively strong demand for that. Initially, they marketed 10.5 million shares at a range of $32 to $34 each. They ended up selling 12.1 million shares at $35 each. So there they saw higher demand, but we'll see. I don't think the shares were open yet, but we'll see how they're doing on that first day of trading. What is Oddity, by the way? It's the parent company of Il Makiage and Spoiled Child, which is a makeup brand and a skincare brand, respectively. And their sort of claim to fame is they use AI in the discovery of molecules and the stuff that they're using.
I didn't
realize
that bit about AI. Of course, I know Il Makiage. I'm a little bit into skincare, so I haven't tried their products yet. See if you can come back with some swag. I'm just kidding.
Yeah, so I mean, this is Il Makiage at one point was known for sort of its maximalist look, which has come out of vogue a little bit, but it has managed to keep up sales of its products. I should mention, as IPOs go, this company is a profitable one. They already earned a profit, $21.7 million in net income in 2022. So not huge, but different than some of the
Different
others.
than Kava. I mean, we knew that Kava going into it was not profitable, and it would be some time before they were profitable. So definitely different base case for Oddity.
And again, this afternoon, I'm going to be down at the Nasdaq. Stay tuned for our 3 to 5 p.m. show. I will be speaking with the CFO of Oddity. Followed that debut. You don't want to miss that. Let's get a quick check on the markets before we leave you, shall we? As we see all 3 major averages that have been pretty steadily in the green here. Not spectacular gains, but solid ones.
A little bit.
Head throughout the session. Jared Blickley's got you for the next hour of trading.
Stay with us.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Jared Blickery, and here's what I'm watching today. Goldman Sachs closed out big bank earnings this morning, and results were not pretty, with profits tumbling 58% in the second quarter. We're going to break down what else these big bank results mean for the rest of the earnings season. And the White House is taking new action to fight inflation by cracking down on mergers and acquisitions. We're going to explain this in the hour. Plus, how Hollywood's strike is impacting streaming giants like Netflix. We're going to give you the finest from the picket lines, and that is coming up. But first, let's take a quick look at the markets. We have another update underway. The Dow, by the way, is up to, looks like it's going to be 8 days straight. And you can see up 151 points today, not quite a 0.5%. S&P 500 up less than 0.3%, and the Nasdaq up 0.25%, worth 37.8 points. And let's take a look at the Treasury market as well. 10-year hasn't been doing too much recently, but we've seen it holding course well below 4%. And you can see the 10-year down about 1 basis point to 3.78%, while the 5-year is holding at 4%. Well, profits plunged at Goldman Sachs during the second quarter. The Wall Street giant saw its investment banking revenue decline 20% from a year ago, and the impairment charges helped drag earnings down 58% to $1.2 billion for the quarter. So how does Goldman Sachs square up against some of the other big banks that we've seen this earnings season? Yahoo Finance's David Hollerith is here to weigh in. David, please take it away.
Jared, the call just finished up, and CEO David Solomon said that, he pointed out that it's been a very tough quarter, but also did point to things to come that could be bright spots. Now, the bank has been telegraphing that it's trying to pivot its business. It's moving away from its one-time efforts to get into consumer lending and trying to focus more on its core business now. How it's stacked up this quarter to the other major banks, just if we're looking at more of the Wall Street type revenues, which is trading and investment banking in particular, Goldman has shown better than expected results in trading and worse than expected results in investment banking. That's compared to a year ago, the drops. Now, Morgan Stanley has shown the worst in trading so far, and Citigroup has had the highest loss or drop change from a year ago in investment banking. As far as Goldman goes, it also had nearly $1 billion in one-time impairment charges, or what the bank is trying to tell us has been a one-time impairment charge. And that was a focus on the call. Analyst Mike Mayo with Wells Fargo was asking about that. And really, I think the question there is whether or not GreenSky, this company, this consumer lender that they purchased back in 2021, will be sold. And it does sound like that is happening, and that this will be sort of the end of the markdown. There are also severance charges too. So Goldman obviously is moving away and is trying to grow its asset management and wealth management businesses, which Solomon had said will take years to grow. Morgan Stanley, obviously a close competitor, has been building its wealth management business for the past decade, and that obviously cushioned their revenues a lot, and it shows why they did not have quite the same amount of losses as Goldman has seen this quarter.
Yeah, really interesting to track Goldman versus Morgan Stanley, because both of them only became banks over the global financial crisis. But I want to move on to something else, David. As more smaller and mid-sized banks are reporting earnings, something to watch out for is higher capital requirements. Jamie Dimon has been talking about that. And Yahoo Finance's executive editor, Brian Sozzi, spoke with Bank of America chairman, Brian Moynihan, and CEO there, what he expects for this sector. And let's take a listen to that.
If you do this across the whole banking system, and that's why we're all awaiting these rules, but we hope that as the rules come out, they're balanced in terms of international competition. In other words, that right now, America and Europe appear to have the same rules, but they are advanced and we're in standardized. And if you listen, they're saying, well, we're going to go away from the models and all those things. That was the basis of Basel III, to get to advanced. So our advanced RWA are 1.4 trillion, our standardized are 1.6. So we have to use the higher under America's rules. That's not true in other locations. And so we have to be careful about keeping the balance and the competitiveness of the U.S. banking system, which is key not only to America, honestly, but it's key to the whole world, because the strength of our banking system actually helps the world prosper.
So interesting words there, David. Your thoughts?
Yeah, I mean, I think, just to put it simply, the amount of capital that banks have to hold, that obviously controls how much they can actually make use of their money, as opposed to holding it on hand in case of deposit changes. And I think that we're getting a lot of different regulatory results with the Fed stress tests that came out a few weeks ago, which sort of tested a different thing that was more for how banks held up during an economic recession. And what this is more so a change for banks over $100 billion in assets to meet the standards that the biggest banks have. And so that's going to change a lot of what they can do with their capital. And, we have to expect something like a long period for this rollout, as with the big bank regulations that have been set in place since I guess they were established in 2018 and are still being rolled out. But, the big banks are ahead as far as that goes. And, we're looking at some banks in particular that are right on the cusp, like U.S. Bancorp. And, they are in a more difficult position to do it. But there is a strategy for how they can sort of optimize their capital in such a way that it doesn't so much reduce how much they can lend. But that is obviously the concern here.
Yeah, it seems to me a lot of these big bank CEOs not necessarily liking the new capital requirements, but we'll see how it shakes out. Thank you for that report, David Hollerith. Bulls are running with the markets once again. The Dow is leading, eyeing an 8th straight win. That's the longest stretch since before the pandemic, and that was in September of 2019. Day after day, stocks are putting on a hurt on the shorts, and here to provide some perspective and precision to the current market environment is Brian Shannon, founder of Alpha Trends and author of Maximum Trading Gains with Anchored VWAP, the perfect combination of price, time, and volume. Brian, we're going to get to VWAP in a second, but you heard Brian here talk about some of the banks. Just your big picture overview. I'm going to go to the Wi-Fi Interactive. I have some of the charts that you brought along today, and I'm going to be annotating. Here's a 3-year chart of the S&P 500. Let me just bring up your weekly chart of the SPY index here that tracks it. We got some lines and some arrows. Why don't you tell us what's going on and what you think of this market?
Sure. I mean, we're clearly in a fantastic uptrend. We're above all those moving averages you see there. We had undergone that period of accumulation, which we broke out past in May. And since then, as we've made these higher highs and higher lows, it's really been a very strong uptrend. So we've got, first up, that first level, 462. I think we might continue to see this rally run up to that level first, maybe break above it a little bit, and then perhaps we see a pause, a rest, and then we could, hopefully recoil and head higher, back up to the all-time highs in there. We've got the semiconductors at all-time highs, and they're not pulling back from there. So that's really some great action overall.
Yeah, it's really fascinating to watch and just keep track of all the new highs. I'm seeing industrials also at record highs. It depends on the index, but semiconductors, home builders, and we were just talking about the regional banks. So I do want to get your take on KRE. This is the KBW Regional Bank Index. Looking at a daily chart here, and now maybe you can set up VWAP for our audience here and anchored VWAP in these lines that we're looking at.
Sure. The volume-weighted average price is a measurement of what is the average price over the course of the day adjusted for each share of volume. When we take an anchor, what we do is we say from a specific point, we want to measure who has control. So that first one that you have circled, the blue one, that's from the beginning of this year. And that blue line builds throughout the year and tells us the average price at that point. So at the average price at this point now, we're back above that anchored volume weighted average price, meaning the average dip buyer who's been buying all year and is now making money. The average short seller is losing money, and they just regained control the last couple of days. The green one below that shows from the low. And notice how when we saw pullbacks over the last couple months to that anchored VWAP from the low, the buyers came in and defended it. So you look at the KRE, and this is where we had disaster with major banks failing, and the resilience of the market in face of that has really kind of set the pace, paved the course, that is, for this continued rally in the broader markets. The inability for them to drag the market down has been really impressive, and now it looks like the worst is probably behind for the KRE, and even XLF looks like it's got a solid base at least. I don't think it's got big upside, but I don't think it's got a lot of downside either.
Well, also taking a look at Tesla, one of our top trending tickers. Seems almost every day they're announcing earnings after the bell. We're going to be tracking that for our audience live. I have a 3-year chart up on the Wi-Fi Interactive here. What are you seeing in Tesla? It has come pretty far, pretty quickly this year. You can see it's up 142% year to date and just making higher highs.
Yeah, amazing run here for Tesla. And, the fundamentals are there to back it up. We'll see tonight after the close if they continue to, or if maybe the market's gotten a little bit ahead of itself. If we can continue to run, I think that prior high middle of last year at about $314, if we run up through that, that might be the place where some profit takers come in. But right now it's up and away. I would just be a little bit concerned over the near term that we've run so far so fast. And a lot of times we see that the good news gets sold into on the earnings. So, the trend is clearly higher. I would not fight that trend by any means at all. And the name of the game is, know where your stop is, know what your risk is, or more important, maybe for people who are really bullish the stock, know your points that where it pulls back down to, you could perhaps add to your position if that's part of your strategy.
All right, we got time for another one here, Roku, and I liked your comment in the chart. As you were annotating it to me, you sent this earlier, if they don't scare you out, they wear you out. And I think what we're looking at here, especially you take a look at the 3-year chart, this stock has just been decimated, and you look at the year to date, okay, maybe that's a bit more impressive, up 90%, but on a 3-year basis, you can see it's still mired in the very low end of its range here. How do you approach a stock like this?
Yeah, so if they don't scare you out, they wear you out. I mean, you can look at there's scores of stocks that look like this. PayPal. You've got I can't think of them off the top of my head, but there's a lot of stocks that have had that huge decline last year. They've gone sideways, and now they're just starting to peak back up. So we've undergone the distribution a year and a half ago, the decline, and the accumulation. Now the buyers are back in control. We're above a rising 50 and 200-day moving average. That means institutional support is here for this stock. And just on the shorter term time frame, we had a nice rally the last week or so. It's consolidated. I just got long this stock yesterday, and I think it will continue to move higher as long as it can hold above basically the low of this week, which is 72.5 or so. This could be a stock that it might be a next leader going forward.
All right, and we'll have you back to see how things are going. Always great to get your insights here. Brian Shannon, founder of Alpha Trends and author of Maximum Trading Gains Through Anchored VWAP, the perfect combination of price, time, and volume.
Thanks, Jared.
You bet. Activision Blizzard is now down fractionally after reporting a second quarter beat on profits, with EPS coming in at $1.08 versus expectations of 88 cents. Net bookings also hotter than expected, up 50% year over year to $2.5 billion. But the big news is the gaming company has given Microsoft another 3 months to close the merger agreement and clear any regulatory hurdles. The agreement was set to expire tonight at midnight. Big breakup fee is now going to go up to $3.5 billion from $3 billion. That's after August 29th. And then it jumps up to $4.5 billion after September 15th. The deal is already a year and a half into negotiations, including talks with antitrust regulators in both the U.S. and the U.K. And in an interview today, the CEO, Bobby Kotick, said he hopes to see resolution with the U.K. government in about 45 days, and that Activision is committed to Microsoft for, quote, as long as needed. All your markets action is right ahead. Stay tuned. You're watching Yahoo Finance.
Will the S&P 500 be higher or lower at the end of earnings season?
Oof, I wish I knew the answer to that definitively. I guess I would say right now the momentum is obviously moving in the higher direction. Earnings expectations, negative 7% growth year over year, so the bar is still pretty low, easy to get over it. I guess if I have to choose one, I'd say higher.
Let's do a quick check of the market sponsored by Tasty Trade. You can see the Dow in bull territory up 150 points or so, 43 basis points. Nasdaq up a little bit more, almost a 0.5%, up 69 points. And the S&P 500 right in the middle, up 38 basis points. Recession fears appear to be easing somewhat for the moment, but most investors are still looking for the best ways to help their clients construct their portfolios going into 2024. According to a survey from Verify, 40% of financial advisors are still concerned about a recession in the next 12 months. And as part of the ETF report brought to you by Invesco QQQ, let's bring in Verify Chairman Tom Lydon to discuss how to be looking at fixed income ETFs. And this is as there are proxies for long-term investments. Tom, thank you for being here today. Always nice to get your insights in here. We have an interesting market. The tape is saying something that maybe macro conditions aren't, but we're in a big bull trend. How are you preparing some of your clients for next year and the potentiality of a recession?
Well, absolutely. We're going to have, Jared, a meeting coming up next week. Many feel that that's going to be the last rate hike that we're going to see by the Fed, which is going to be very, very welcome. And most advisors, as we survey them regularly, feel that a year from now, rates will be lower. So it's nice that they have money on the sidelines. There's a record $6.2 trillion in money market funds. It's paying 4.5% to 5%. But advisors and investors are going to be forced to get that money to work, both on the fixed income side and the equity side. So they're going longer duration. They're going up the credit curve by going into corporates and high yields, because if we actually do get a recession, the Fed then will be forced to get out the hatchet and start chopping rates. And it's not going to be an orderly fashion of 25 bips every month. It may be as much as 100 basis points at a whack. So those are things that you don't want to miss out on. You want to get back allocated, especially if prior to 2 years ago, you had a 60-40 allocation.
Tom, I think you raised an important point, so I just want to hammer that home a little bit. The Fed, when it's raising rates, tends to ratchet up slowly and very evenly, quarter point, or half point. When it slashes and burns, well, it's doing that because of a reason. There's problems in the economy. So if you're getting 5% in a short-term government security today, that can quickly change overnight in 6 weeks when the Fed potentially cuts maybe 200 basis points across 2 meetings. So how does this fit into your thinking about your preparation for the markets?
Well, absolutely. I mean, you think about it, it's been emotional over the last couple of years for sure. And the fact that you're getting paid to have money on the sidelines makes you feel good, especially advisors, clients are saying, I'm okay avoiding volatility, which is the biggest concern for clients these days. However, you have to think about where the puck is going. And advisors now are putting that money back to work, not just in fixed income, but also in the equity markets. And when you look at the other side of the balance sheet, for the first time in a long time, in the last month and 3 months, we're seeing the Russell 2000 actually keep in line with the S&P 500, which is really welcome, as top 10 stocks in the S&P has really dominated and pushed that index forward. Now we're seeing more of a broad-based rally, not only here in the U.S., but also overseas as well, which is very welcome.
Yeah, we've seen emerging markets pick up. We've seen industrials pick up. XLI at a record high, along with XLK. I didn't think that would happen a couple months ago, but here we are. We have a very bullish tape. And according to the survey we've been talking about, and here's one of the questions, Vetify asked financial advisors, so people who are managing money, what are you most concerned about over the next 12 months? Market valuations comes in second, 24%. So in other words, maybe stocks are too high. That's what I'm thinking. And then recession is 40%. We talked about that. But should clients, should financial advisors be thinking defense at this stage when there's a huge amount of catching up, it seems the market wants to do to these mega cap leaders?
Well, there's a lot of money on the sidelines, number one, and also there's a lot of pent-up demand. You're starting to see a bit FOMO, both on the equity side and fixed income, and we're seeing that in ETF flows. All of a sudden, this year, we're seeing as much money going into fixed income ETFs as we've seen into equity ETFs. And that really hasn't happened for a long, long time. So the good thing is money's being redeployed back into the market on both sides of the balance sheet. That's good. At the same time, what you don't want to do is find yourself with a big cash position a year from now with lower rates and the bond market and the stock market continuing to perform well.
And I think another concern of investors, if they have this FOMO and they start chasing the market right now, well, what happens then if the market rolls over? Of course, that kind of thinking would have kept investors out of the market year to date. But how should investors be thinking about these kinds of defensive questions?
Well, a couple things. Look at valuations. The S&P, the Nasdaq 100 is really expensive right now. But if you go into areas like the Russell 2000 or overseas markets, the PE ratios are 10 to 12, where they're 22 to 23 with the S&P, and a lot more with the Nasdaq 100. So you can basically get stocks half price if you shop around and diversify. I mean, look, we saw out of the financial crisis, it was really tough to beat the S&P 500. And the areas of the market that we're talking about now drastically underperformed. Eventually, the pendulum will swing, and we're seeing generational opportunities in those areas of the markets where people on Wall Street who've been at it for a while are saying, you just can't stay away. And those that have been leaning in the last 3 months have been well rewarded for that.
And Tom, we got time for one more here, looking at some of your ETF recommendations. Noticing you like a Vanguard FTSE Developed Markets ETF. That's interesting to me. Maybe explain some of the reasoning behind that. And then also, we talked about the Russell 2000, but then also the financial sector, you have the SPDR ETF XLF. So looking at VEA and XLF.
Yeah, so with VEA, we've had a home country bias. And if advisors and investors look at their portfolio, with 55% of market capitalization being outside the U.S., we are underweighted. It's been unloved, but now we're actually seeing it come back, and you're able to buy really good companies for good prices. So this is the biggest international developed market ETF. You're going to get good representation there. And as far as IWM, that's the Russell 2000, the biggest representation in the ETF marketplace where you can get it very, very inexpensively. And then finally, there's a lot of news about financials and banks. They're really doing well. They're beating expectations, even with the unfortunate news on Goldman today. But this also has other companies like Berkshire Hathaway, Visa, MasterCard. And with higher rates, these companies are really benefiting and will continue to benefit if we have higher rates for longer.
All right, we're going to end it there. Always appreciate your insights. Thanks for joining us here. Tom Lydon, the VettaFi Vice Chairman.
Thanks, Jared.
You bet. All your markets actions remains ahead. Stay tuned. You're watching Yahoo Finance.
What sector is going to perform the best during earnings?
What sector is going to perform the best? I would say probably not tech this earnings season, partially because it's run up already so far and the guidance needs to justify the valuations. Financials have done really well. We may have already seen the best sector during earnings season. I think energy actually has a good chance to do pretty well as well.
Yahoo Finance's executive editor Brian Sozzi sat with Bank of America CEO Brian Moynihan, spoke about the bank's earnings results, the state of the consumer, and the health of the U.S. economy.
Since last earnings call, we felt more comfortable that we'd have a better outlook for NII in the second half of the year than we did then. And it'd be basically flattish quarter to quarter between 14.2 and 14.3, and then be above 14 in the fourth quarter. And that really comes from just the sheer power of our franchise, whether it's we're getting 4% annualized loan growth, which is good on the commercial side especially. We're seeing some card growth. We're seeing the deposits hang in there, even though, because we have such excess funding position, we're not competing for high cost deposits. We put those customers' money into the market and money funds and other things, and we actually even raise money from our customers for other banks to give them those rates because we don't have a use for the cash. And so even with all that going on, we feel good about the NII, and that's basically due to the power of our deposit franchise.
Is this outlook, Brian, your way of signaling to markets that this economy is going to see a soft landing from the various actions the Fed has taken?
Yeah, it's a little chicken and egg. We build our outlet based on the market expectation for rates. But let me back up, Brian, and talk about we have our research team led by Candace Browning-Platt that does tremendous work, and they basically have the first two quarters of 24 to be slightly recessionary, negative 1% GDP growth rate in the first quarter to 0.5% in the second quarter. So that's a pretty light recession at this point. And they've moved it out from this year into next year, and they've moved the duration to be shorter. So as you think about it, whether it's a soft landing, meaning it never goes negative or it goes slightly negative, I'm not sure people will feel the big difference. And what we're seeing in our customer base is the economy, the spending that goes on in our customer base, which is $4 trillion plus a year, which was growing at 10% a year for all the year 22 over 21, for example, has now slowed to 5%. And that 5% is very consistent with a low inflation, more normalized growth economy in the U.S., kind of what it was in 17 or 18 or 19. And that's good news, frankly, because that means the economy is getting back in line, even though we haven't had massive dislocation in employment, although employment markets are softer than they were a year ago at this time.
Are you surprised by this consumer resilience?
I'm not, honestly, and we've been saying this for a long time. This was going to be the Fed's hardest job, was to slow down the U.S. consumer, because at the end of the day, the amount of stimulus the consumer had, the fact that unemployment has run as low as 3.4%, the fact that wage growth, you see a lot of talking about what's caught back up to inflation, but if you go look at from the pandemic forward, the wage growth from 19, 20, 21 was very fast, and then it fell behind inflation, but cumulatively it's ahead of inflation. And so if people are working and they're getting paid more and they're spending, it's going to be hard to have a tough, U.S. economy because of the amount that's driven by that. But on the other hand, you don't want them doing too much and feeling like they're getting behind on inflation, therefore demanding higher wages to get a wage inflation spiral. It looks like the Fed's was probably too late, and they said it themselves of getting in the game and raising rates. Then they finally moved very quickly, and they've caused that to slow down. And I think that's all good. But I'm not surprised by the resilience of the consumer, because when we looked at our customer data, you can go back and track us talking quarter after quarter. Our customers still have multiples in their accounts. So the same customers that were here in early 2020 today have multiples in their accounts than they did back then, especially in the lower balance accounts. And that's because they've spent some of the stimulus, but they've been earning money and they've been managing their finances well. That doesn't mean certain ones are having difficulties and layoffs are happening, but in a broad context, across 60 million customers, across $4 trillion of spending, it's a pretty resilient group.
Do you think consumer spending, Brian, will surprise to the upside later this year? We are now finally starting to see inflation slow pretty dramatically in this country. And looking at your results, to your point, you have a lot of people with a lot of money in savings and checking accounts that maybe they could get out there and spend in the back half of this year. How do you see it?
Well, if you think about the last few years, first it was good spending. They bought things because they're pent up in a house and they just had money and they bought stuff, and so they bought a new couch or a new grill or things like that. But you can only buy one of those. So then they started spending on what we called experiences, going out to eat, going out to movies, going on trips, and you still see travel's fairly strong, and you can see the bookings. I think all that, once people have done a lot of that, got a normal summer vacation in for their kids out of school, I think it'll sort of reach what it usually does, is sort of 3, 4, 5% going faster than the rate of inflation, because the wealth of the country grows, and I think that's good. Now, the best news is that the credit creditworthiness of our customers is still extremely strong. And people keep talking. I get asked about, well, your credit card charge-off rate went up a little bit, or your 90-plus delinquencies went up some. But if you look at that number, it's still far below where it was in 19. And if you and I were having this conversation in 19, we'd be talking about 30 and 40-year record lows of credit costs in our company. And that's so we're normalizing to a very good place. And so I think that also means the consumer has some staying power, the equity in their home. And so, in the end of the day, if companies are making money and employing people, even though it's not as aggressive out there in the markets today on labor, people are going to have jobs and people are going to spend. But I think they're slowing down their activities because, frankly, if all they read about in the papers are going into recession, that kind of has an effect. And if things like a new car cost a lot more and interest rates, or a new home mortgage rates above 7%, those slow down the activity. But that's what the Fed intended to do.
Yeah, Brian, I think this is the recession that everybody's been calling for a while. It just may not happen. But I want to go into commercial real estate. I looked at your results. When I see your results, I don't hear you calling out big negatives on commercial real estate. Why is that the case for a Bank of America, but a completely different story over at a company like Wells Fargo?
Well, I can't reflect on other people, but we disclose. It comes from what we call responsible growth. For a long time, we've looked at, in the commercial real estate business, to keep that as a percentage of our loans at a size in total, and even the office piece of that, to work with great sponsors of people in the buildings, great real estate owners, and then, frankly, make sure the terms are reasonable.
Fears of a recession still loom on investors' minds with the next Federal Reserve meeting taking place next week. According to the recent Global Fund Manager survey from Bank of America, market sentiment remains bearish. 60% of investors are expecting weaker global growth with only a mild recession, while the concession on when the recession may happen isn't so clear. A definitive supermajority, 68% of the participants in the survey, they thought there would be a soft landing in the next 12 months. Another thing piquing investor sentiment is the AI adoption, artificial intelligence, given the leap in advancements in the technology that we've seen recently. And now 42% of investors think that AI adoption will increase profits for businesses. Only 1% of participants, however, thought that AI would be able to add more jobs to the economy. Now, all your markets action lies ahead. Stay tuned. You are watching Yahoo Finance.
I haven't seen you in a long time. I know you went to the Super Bowl because of your gig.
Oh, that's been a long time.
It
Yes.
has been a long time.
Yeah.
But what has that been like working for SoFi, getting to do stuff like that, like going to the Super Bowl?
Yeah, well, I make this joke all the time. SoFi is the fourth company I've worked for, and it's the first one that's less than 100 years old. So it was a pretty big transition, and I went really direct to consumer at that point. So instead of being in the intermediary space or in the institutional space, it put me right in front of the end investor, and that has been so fun. And again, the investor base has changed, and I've gotten to talk to younger investors and hear their questions and do a lot more educating for people that are getting started in their investing journey. And it has been a lot of fun.
In the race for 2024, President Biden is telling voters he is a president for all Americans, and that's a quote. His supporters praising him as a centrist who could win swing voters, just as he did in 2020. Now let's bring in Yahoo Finance's Rick Newman, who has his eyes, as always, on the election. There he is. Hey, Rick, what should we expect?
Hey, Jared. I'm monitoring all these messages from the Biden campaign and from the surrogates for the Biden campaign. I started scratching my head a little bit when I saw all these claims that Biden is a moderate president, a centrist. I guess you could say in terms of the things that he has actually accomplished, yes, there are some bipartisan and some things you could call centrist there. Infrastructure spending, for example, that got bipartisan support. The CHIPS Act to support the semiconductor industry got bipartisan support. But also worth noting that Biden has tried to do a lot of things that the progressive or the more liberal part of the Democratic Party really pressed him to do, and he simply has not been able to do it. He tried, he just couldn't get it done. He tried to wash out a lot of student debt, and last month the Supreme Court said, no, you can't do that. So he has a much less ambitious plan now to get rid of some student debt. During the first 2 years of his presidency, he pushed a really big package of spending, tax increases on the wealthy and on businesses, along with a lot of new social spending, and he just couldn't get the votes for it. So he has been a pretty liberal president in terms of the things he has tried to do, but he doesn't want voters to really remember some of that stuff because his team thinks that the way he wins in 2024 is he has to appeal to moderate swing voters who may not be affiliated with either party. So that is the rhetoric you're going to be hearing from Biden and all his supporters for the next 15 months.
Well, Rick, shifting gears a little bit, the Wall Street Journal reporting that senators are introducing bipartisan legislation that would bar members of the executive branch and also lawmakers from owning individual names, individual companies and stock. Please give us the details.
This feels like a golden oldie.
Yes.
There have been many proposals to ban stock ownership by members of Congress. I guess it's a bit of a new thing that they're now extending this to the executive branch. There have been some exposés showing it's not just members of Congress who may profit on inside information when they know something is about to happen and then either snap up a company's shares or sell the company's shares ahead of bad news. Apparently, this happens to some extent among regulators in the executive branch, too, and they know a lot about punishments, for example, or different types of regulations that might be coming out that might affect different companies differently. The argument against this has been that, people in the government should be allowed to invest like anybody else in the United States. They don't actually get paid a lot of money. But I think there's a valid counter argument, which is to say these proposals would simply ban the ownership of individual stocks. You could still buy mutual funds. You could still buy ETFs and things like that. So if you wanted to profit from insider trading as a government employee, you'd still be able to invest in sectors or themes if you knew something was going to happen and you want to profit from your inside knowledge. You just wouldn't be able to invest in individual companies. I would add, none of these has ever passed before. There have been some limited rules that have passed, but never a complete ban on stock ownership, and I don't think that's going to happen this time.
Yeah, I don't see the public cry for that either just yet. So thank you for that report, Rick Newman.
See you, Jared.
The White House taking a new action to lower inflation by cracking down on mergers and acquisitions. Yahoo Finance's Jennifer Schonberger joins us now. Jen.
Hey there, Jared. Good morning to you. President Biden convening a White House competition meeting later this afternoon as the administration seeks to put forth 3 new proposals to increase competition in an effort to bring down inflation. Amongst those proposals, the Federal Trade Commission and Justice Department are announcing more than a dozen new guidelines for how to better evaluate a merger's effect on competition. The Department of Agriculture has partnered with more than 30 state attorneys general to combat price gouging on groceries. And in a major change, housing rental websites Zillow, Apartments.com, and AffordableHousing.com have agreed to disclose all fees up front on their websites to prospective renters. The White House says the change will offer consumers transparency into fees like the cost of applications or trash removal so they can better comparison shop for the lowest rent. Now, these M&A guidelines, which include ensuring mergers don't significantly increase competition, come 1 week after a federal judge blocked an attempt by the FTC to stop Microsoft from acquiring video game publisher Activision Blizzard. Senator Elizabeth Warren applauding these M&A proposals this morning in a statement saying, quote, giant corporations and their armies of lobbyists will cry foul at the prospect of more competition. But this action by the Biden administration is welcome news for American small businesses, workers, and consumers. Now, President Biden will convene the White House Competition Council meeting for the 5th time this afternoon at 3 p.m. Attendees include Agriculture Secretary Tom Vilsack, Acting Labor Secretary Julie Su, and FTC head Lena Khan. This Competition Council created 2 years ago by the president under executive order in an effort to combat anti-competitive practices. Jared.
Thank you for that report there, Jennifer Schonberger. All your markets action ahead. Stay tuned. You are watching Yahoo Finance.
As you pointed out in a recent note, you've been doing this 19 years now. I think you and I have probably been doing it about the same amount of time. What is the biggest lesson the markets have taught you in that time?
That's a great question. So I say this to kids that I mentor all the time. I say this to young professionals. The first crisis you go through, the first bear market you go through, shapes you. And the first one that I was really in it for was the 2007-2008 crisis. So I am obsessed with credit. I'm obsessed with spreads. I'm obsessed with lending, right? And watching all of those indicators. This particular market cycle has taught me that although all of those lessons are still important and important to remember, the investor base has changed and the reaction function, the quickness with which we react to things has changed. So you do have to continue to be moldable throughout your career. No matter how much experience you have to continue to be moldable and allow for those changes in who is actually putting their money to work.
The Dow poised to hit an 8-day winning streak as stocks gain on strong bank earnings. For more on what we can expect this earnings season is Jill Malandrino, Nasdaq Global Markets reporter. Hey, Jill.
Hey, how's it going? And second quarter earnings season is off to a strong start. Of the companies in the S&P 500 that have reported results, 82% have exceeded expectations, according to FactSet data. For many investors, the recent streak of gains bolsters the case for a soft landing scenario. It's an outlook that has gained traction after last week's encouraging inflation data and recent jobs data that suggest the labor market is cooling a bit. Looking ahead, analysts still expect earnings growth for the second half of 2023. For the third quarter and fourth quarter, analysts are projecting earnings growth of 0.1% and 7.6% respectively. For all of 2023, analysts predict earnings growth of 0.6%. Investors are now shifting their focus to earnings from big tech companies as their performance has been fueled by lofty expectations. The market will be eyeing not if, but to what extent artificial intelligence will dominate these firms' forward-looking guidance. Generative AI may not have boosted second quarter figures, but it may very well expand this quarter's product offerings and available target markets. Wedbush analysts believe that a new tech bull market is taking shape, propelled by the AI revolution. They predict an above-average second quarter earnings season for the tech sector in the coming weeks. Wedbush also sees enterprise IT budgets showing signs of improvement in the June quarter, with AI spending becoming a reality and not just hype.
Jill, I want to switch gears for a second and talk housing. The number of available homes for sale hit the lowest level ever last month, and that's according to Zillow. What can we expect for the housing market in the second half of this year?
Well, it's a supply story, is simply what it is. U.S. single-family housing starts, which account for the bulk of home building, dropped 7% to a seasonally adjusted annual rate of 935,000 after surging in the prior month. But permits for future construction increased solidly as a severe shortage of previously owned house sales supports new construction. Now, housing supply remains well below pre-pandemic levels, driving groundbreaking on new projects. A survey on Tuesday showed the National Association of Home Builders Wells Fargo Housing Market Index increased to a 13-month high in July to 56, with fewer builders reporting offering incentives to attract buyers. A reading above 50 is considered a positive sentiment. Builders say low supply in the resale market is driving demand for new construction, but higher mortgage rates and supply-side challenges continue to put pressure on the overall market. The average rate on the popular 30-year fixed mortgage crossed over 7% briefly in May, and then again at the end of June. It's only come down slightly in the last week. Those higher rates are straining affordability in the market, where prices for existing homes are rising yet again due to inventory constraints, making it difficult for people to enter the market, especially first-time buyers. According to KPMG, roughly half as many homes for sale as there were in 2019, and even fewer listed for $300,000 or lower. It's also important to note that a majority of homeowners are locked into sub-4% mortgage rates, and they're unlikely to list homes unless there's a life event forcing them to do so. So again, more supply constraint concerns.
That's right. If you got that 3 or 4% mortgage, sit on it. You're doing yourself a favor. Thank you for that, Jill Malandrino. Hollywood is still on strike, with more actors joining the picket lines day by day. What could this mean for Netflix's much anticipated earnings release after the bell today? We're going to jump coast now to join Yahoo Finance's Arlie Garfinkel at the picket lines in Los Angeles. Allie, boots on the ground. What are you seeing there?
Hi, Jared. So it's 9 a.m. here in Los Angeles, and the picket lines are just getting set up right outside Netflix's offices. On one hand, I'd say it's a social environment with some edges. On one hand, you have a lot of people drinking coffee, shaking hands, saying hello, and on the other hand, the LAPD is here, and the stakes are incredibly high. Now, of course, Netflix in particular has been a focal point of this strike. Remember, Netflix has come to represent the streaming revolution, the change in the economics of entertainment that so many of these writers and actors are most worried about. And of course, let's not forget, for Netflix itself, the stakes are high. Remember, the company spends about $17 billion annually on content at places like this one, the one I'm standing behind, Sunset Bronson Studios. And today's Netflix earnings, and I would say that one of the key questions is whether Netflix is set to weather this strike. And ultimately, the answer from a company like Moody's is yes. Netflix has a couple of key advantages. One of them, of course, is that it has a lot of content investments internationally. Think about some of Netflix's biggest hits of the last few years. For instance, Squid Game, shot in South Korea. The other thing, too, is because they have that broad catalog that's both domestic and international, they could be set to weather a bunch of different changes. And lastly, of course, they have a profitable balance sheet. So there is a lot of optimism that they are set to weather this strike. However, I would say there is one wrench.
Yeah.
Netflix is in the process of changing its business model, right, Jared? There's the ad-supported tier. You've got all sorts of stuff like that where, for instance, you have the password sharing crackdown. So in the end, the industry-wide change that could come on the other side of this strike is actually what I think they should be worried about. But that's down the line, and it's going to be a long, hot summer in Los Angeles.
Allie, we got another minute here. I know you said it's only 9 a.m. there on the West Coast, but have you had the chance to talk to anybody there and just get a feel for the sentiment and kind of the attitude that pervades right now?
So far this morning, it is 9 a.m. People are just coming by. Actually, we have people walking by us right now. I would say the sentiment is actually one of optimism. Right, I was just talking to one of the organizers who said, we are actually really excited. We think we're asking for reasonable things. We think we can get what we want. And we think there is a lot of pressure on these companies. So I would say the sentiment is one of optimism, but make no mistake about it. I think everyone is really hunkering in for a long haul. The sense I got by the time I got here, Jared, everyone was already set up. This is an incredibly organized endeavor.
Long haul. Well, you heard it there. Allie Garfinkel, thank you for that report. And let's do a final check of the market right now. We are in rally mode, and I'm looking at the Wi-Fi Interactive. We have the Dow and the Nasdaq and the S&P 500 in positive territory. Dow is leading up 0.5% now. Want to check out the sector action real briefly. We've had energy, that has been, and now real estate taking the forefront, but energy also up more than 1%. Materials and industrials, those are the two sectors mired in the red there. We'll take a quick look at the bond market. The 10-year T-note yield by 3.79%. It is not changed one bit on the day. Just taking a quick look at the 30-year, that is down 1 basis point to 3.89%. That's it for now. I'm Jared Blickery.